fell because of the tariffs. We had this big sell-off, and we've now recovered.
I think this momentum is real.
This is an interesting inflection point. There's potential for upside.
This is not a particularly screamingly broad rally.
I think the markets are starting to conclude that, you know what? Uncertainty is going to be with us here for a while. Let's move on with our businesses.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, expectations are sky high. The Ukrainian leader arriving in Washington for talks with President Trump. As economists look to Jackson Hole for chair Powell to tee up rate cuts, investors look to retail earnings to gauge the health of the U.S. consumer. We're facing down a week full of event risk.
Yeah, we've got geopolitics, we've got monetary policy, and of course we've got corporate profitability all on deck this week as we try to understand what the framework is going into the remainder of the year, with stocks at record highs, with corporate bond spreads at record lowest rates since 1998. A key question is going to be what comes out of Washington, D.C. today. And then on Friday, what does Jay Powell signal in terms of whether he's going to push back against rate cut expectations or whether he'll lean in and try to gain curry favor with the president?
Well, let's start with Washington, D.C. in the main event later on this afternoon. Just how high is the bar? European gas prices falling to fresh lows for 2025. I'd say that bar is pretty high.
Well, pretty much also as well when it comes to secondary sanctions. We are not seeing them just yet. When the president said we're going to see severe consequences if there's no cessation of hostilities, well, we don't have a ceasefire and there's no severe consequences. When it comes to this meeting, the president has made it clear it is now up to President Zelensky to get it done. Two big things on the table. Security guarantees. This is the conversation Zelensky wanted to have 6 months ago during that Oval Office blow-up. And as well as what does it mean for territorial swaps? What exactly can Volodymyr Zelensky accept and then go back to Ukraine and say that this is palatable for his people?
The president of the United States putting some additional pressure on the Ukrainian leader ahead of this meeting, with the European allies joining him alongside the president.
Yeah, to me, I think who's going to be in the room is actually really important. When you take a look at the roster of European leaders who are lining up, who have canceled their schedules, cleared the decks to be there. Giorgia Meloni, you've got Friedrich Merz, Emmanuel Macron, Alexander Stubbs, Mark Rutte, Ursula von der Leyen. They all are coalescing in Washington, D.C. because they understand how pivotal this is and that Ukraine is being asked to give up land in response for a peace deal without some sort of ceasefire. The lack of, I don't want to say trust, but the trying to fortify Volodymyr Zelensky is quite clear in terms of the European message.
At the same time, you're going to talk about security guarantees and a NATO-like security guarantee for Ukraine. You have to have the Europeans in the room. They have to be part of this conversation because they're going to be the ones likely that have to send boots on the ground.
Those meetings take place a little bit later on this afternoon. So far this morning, equities doing okay, just slightly negative. We're down 0.1% on the S&P. Coming up this hour, we'll catch up with Steve Chiavarone of Federated following a second straight winning week for stocks. Grieco of the Stimson Center as Zelensky heads to the White House, and Neil Dutta of Renmac looking ahead to Chair Powell in Jackson Hole. We begin this hour with Stock Steady. Steve Chiavarone of Federated Hermes writing, we continue to see an economic acceleration. We expect that the Fed will typically look in the rearview mirror and cut in September. Steve joins us now for more. Steve, good morning.
Good morning.
It's good to see you, sir. Equities just off all-time highs. Investment-grade credit spreads going down towards the tightest levels we've seen so far this turn of this century. I want to understand from you whether that is justified or not.
I think it is. I think so we have a non-consensus view, right? The consensus view out there is that the economy has been slowing and is continuing to slow or decelerate. I think that's an artifact of misreading the data. And I think what's coming through, especially post the jobs revision data, is that you actually had a kind of real slowdown in that April-May period after Liberation Day, where everything ground to a halt. And you're starting to come out. You're starting to see the jobs numbers, even though it was only 75,000 or 73, that was ahead of the 14 and 19 the prior 2 months. ADP has that same pattern. Unemployment claims have that same pattern. Confidence data has that same pattern. Earnings data has that same pattern. And so I think the actual story here, and if you look at the character of the market, it's acting early cycle-ish. It's kind of rates down, cuts coming, credit spreads, they can't improve any further. They're about as tight as can be. And economic data that's starting to accelerate, including some of the inflation data, which hasn't really been about goods prices or tariff goods, but it's been about service prices starting to firm again. So I think the Fed should cut, but I think they're going to cut for the wrong reason.
They're going to reaccelerate the economy.
Yeah.
Going to layer on top rate cuts. Where do you want to be if you truly believe this is early cycle?
Well, you've got to look where there's value and where you're starting to see positive price movement despite, names that have really underperformed. You see that in the early cyclicals. You see it in places like home builders. You see it in places like trucking and shipping. Now, this will all depend on what Jerome Powell does later this week. If he endorses the cut, then I think that early cyclical trade will continue and we don't have the normal seasonal weakness. If he comes out hawkish, then I think you'll see a step back and you'll revert back into the growth and defensive names.
So basically, this is a market that's counting on rate cuts to reaccelerate any kind of growth and signaling, at least when you look at market valuations, that there isn't necessarily a need for rate cuts. I mean, this is sort of the paradox that a lot of people are looking at. How can you justify the need for rate cuts when you have markets that are pricing in a reacceleration, early cycle growth at a time where inflation's not down to 2%?
So I think it would depend on where you're starting with rates. If we were at a neutral rate stance, if we were somewhere around what the neutral kind of level of rates would be, then yeah, talking about a cut here makes no sense. I think the reason why you need a cut, and I think the Fed does need to ease, is because what you've got is an economy that's very strong around tech and tech capex. But if you look at the rate-sensitive parts of the economy, if you look at the housing sector, if you look at autos, if you look at anything that's not on that tech capex story, there's some struggles there. There's some pain that are logical given how far and how significantly the Fed raised rates. You don't want to have a scenario where tech and tech capex slows down and you can't hand the baton off to that other part of the economy that's struggling. And so the issue isn't so much that the economy can't reaccelerate or that there's some immediate need of rate cuts. What it is that if you keep rates this restrictive for longer and you punish those parts of the economy so severely, you won't be able to hand off that baton.
So let's say we get the 100 basis points of rate cuts that a lot of people are pricing in from now until the end of next year, and you have a Fed that does open up the door to potentially easing policy, even with inflation sort of above their ultimate goal. Do you start to get worried about a bubble? And I know that this is probably going to trigger you, but we're looking at gauges.
That's a strong word.
Well, I mean, I know that you're positive, but we're looking at gauges, the lowest since 1998, resonance of the 2000s .com bubble. I mean, at what point do you start to worry about that?
I would start to worry about that when you see valuations on the non-Mag 7 get out of control, right? So Mag 7 has traded between 25 and 30 times. I mean, Apple has more cash than Great Britain. They're not going to trade at a 15 times multiple, okay? That deserves a little bit of a premium. When you look at the rest of the market, ex-Mag 7, it's trading about 18 times, which is about average. And that's where we see that opportunity. That's where we see that broadening out. So if we were sitting here and the non-Mag 7 were trading at 22 or 23 times, then yeah, that's really rich. But when I look at, despite being at all-time highs, 493 of the 500 stocks trading at an average multiple, I feel like that's okay.
You said you'd be a buyer of weakness if it materializes.
Yeah.
Weakness where?
Well, August, September tend to be tricky just seasonally. If you saw a scenario where, let's say, Chair Powell was a little bit more hawkish than expected and you saw some rollover in those cyclicals, that's where we would be buyers. So small caps, the kind of cyclical, some of the rate-sensitive dividend payers. Because, again, you're going to have to cut. You're moving in that direction. The committee is moving in that direction. The market is moving in that direction. And if there was weakness because of a temporary setback because of comments over the next couple of weeks, I'd be inclined to buy that weakness.
Is this time around even more tricky for August, September because you have geopolitical risk thrown into the mix?
I don't know how much geopolitical risk offers downside risk here. I think, look, if we come out of the next few weeks and we have some resolution to Russia-Ukraine, I think that's a market positive for sentiment. I think it's certainly potentially lower energy prices. I think no matter what happens, you're going to want to continue to be on this defense spending trend, which has been a big one in the market. I just don't know if we don't come out of this with a deal. I don't know that that's really what's driving markets higher. I think the Fed has more of an opportunity to disappoint the markets than geopolitics right now.
Can we finish on valuations? You touched on them. The S&P 500 has evolved so much over the last several decades. What is the appropriate benchmark for valuations now on the S&P?
Yeah, so averages are very dangerous because, again, if I go back where most of that average was developed, you had a much higher weight in manufacturing. You had no subscription-based models. I like to joke around, when I was a kid, if things were tight, my father maybe didn't take us to the movies. If things are tight now, I'd have to be under dire financial straits to figure out what card I use for Netflix and cancel it, right? That deserves also a premium. and then the Mag 7. So Mag 7 are about a third of the market. They trade between 25 and 30 times. If you put a mid-cycle on that of 27.5 and assume an 18 times multiple for everything else, that gets you to an S&P at 21.5, which is where we think you're about fair, 21.5 times. That's very different from the past. But if you've constantly not owned this market over the last couple of years because you thought it was too expensive, you've left a lot of money on the table.
That phrase we hear a lot on this program, price for perfection, just to wrap it up, you'd push back against that, wouldn't you?
I would, because again, you have large swaths of the market, whether it's the financials, whether it's some of the more cyclical parts of the market, even some of the dividend-specific parts of the market that just are trading at, at best average multiples. They're not cheap, but they're certainly not overly stretched, and that's where we see the best opportunity.
Steve, appreciate your time.
John.
Good luck for the rest of the week. Thank you, sir. Steve Chiavarone there of Federated. This is a rich market in the minds of many, but justified in the minds of Steve.
What Steve just said really highlights why it's so difficult to understand how to interpret the Home Depot and the Target and the Walmart results later this week. Is this going to be a gauge of the broader economy, or do we hear what Steve was just saying, which is essentially these companies are not the economy. They have models that are incredibly strong and very profitable, and so all of a sudden are you looking at just the gains of the big and the gains of the strong, not necessarily the gains of an overall economy.
Big week for retailers. Home Depot tomorrow reporting earnings. The day after that, we'll hear from Target. On Thursday, we'll hear from Walmart. Equities at the moment slightly softer, but very close to all-time highs on the S&P. With an update on stories elsewhere and worldwide with your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Good morning, John. President Trump will host Ukrainian President Zelensky and European allies in D.C. today to set out terms for a potential peace deal with Russia, with the focus on territorial concessions and Kyiv seeking security guarantees. This after President Trump and Putin met in Alaska, with little revealed in what was discussed. Meanwhile, Hurricane Erin has re-intensified into a Category 4 storm after moving past Puerto Rico. Erin's top winds strengthened to 130 miles per hour, and according to the National Hurricane Center, additional intensification is forecast over the next 12 hours. The storm is expected to pass between North Carolina's Outer Banks and Bermuda later this week. Meanwhile, shares of Novo Nordisk are rising 2.7% after U.S. regulators gave the green light for its blockbuster weight loss drug Wegovy to also treat a serious liver disease. The FDA approved it for MASH, adding to the list of conditions for which the blockbuster therapy is now approved. Analysts say the move could help turn momentum around for Novo after a rocky start to the year. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, Zelensky at the White House.
I believe we had a very productive meeting. There were many, many points that we agreed on. I would say a couple of big ones that we haven't quite got there. So there's no deal until there's a deal.
Up next on the program, we'll catch up with Grieco of the Stimson Center from New York City this morning. Good morning. What a week coming up, absolutely stacked with retail earnings. It kicks off tomorrow with Home Depot, then on to Target, then on to Walmart. We end the week with the big one, though. Chairman Powell in Jackson Hole, Wyoming, looking for guidance on interest rate cuts. Will he tee up September or not?
Well, what is the incentive to really commit at a time where the data is sending conflicting messages? How does he do this in a way that doesn't seem utterly political to try to avoid the spotlight at a time where the Fed is likely going to cut rates anyway? And that's the reason why a number of people are tempering expectations. I want to understand the framework. Are they going to talk about targeting averages or maybe a higher inflation rate than they have in the past?
Some two-way risk going into Friday with Chairman Powell in Jackson Hole, Wyoming. Equity futures right now in the S&P negative by just 0.1%. On the Nasdaq, a similar move in the bond market. The 2-year bond yield this morning down a single basis point. The 2-year 3.74. Under surveillance this morning, Zelensky at the White House.
I believe we had a very productive meeting. There were many, many points that we agreed on. I would say a couple of big ones that we haven't quite got there. So there's no deal until there's a deal.
We agreed to
robust security guarantees that I would describe as game-changing.
This is not our war. We happen to be in the role of the only country in the world, with the only leader in the world, that can actually bring Putin to a table to even discuss these things.
So here's the latest this morning. Ukrainian President Zelensky and his European allies arriving in Washington for high-stakes talks with President Donald Trump. Trump looking for a quick peace deal, saying Zelensky can, quote, end the war with Russia almost immediately. Bloomberg's Ollie Crook joins us now for more. Ollie, welcome to the programme. How much pressure is on the Ukrainian leader today?
There's a tremendous amount of it. It's been ratcheted up really overnight by President Trump, who, as you mentioned, has said that basically Zelensky can end the war within the next sort of 24 hours, within the next week, squarely putting the ball in his court. The question is, how does Trump feel about the situation right now? He has been sort of softening his tone towards Zelensky, certainly a different kind of conversation than we had 6 months ago. But I think the most significant thing, John, to come out of the last 48 hours since that meeting between Trump and Putin is that the United States is talking explicitly now about Article 5 style guarantees for Ukraine, i.e. that the United States potentially, if there is a deal struck between Russia and Ukraine, would come to the military aid actively of Ukraine if its sovereignty were imposed upon again by the Russians after such a deal. That is something that has not been explicitly discussed by the United States. What I also think is interesting, John, is that they talk about this as a sort of breakthrough from this conversation with Putin and Trump. But this is a guarantee that can be given unilaterally by the United States. It's something the United States could have given weeks and months ago. It's something that the Europeans and the Ukrainians have been calling for some time, but it is now apparently openly on the table. I also think it's interesting now that after those talks that the Europeans want to take full advantage of this momentum, full advantage of the fact that Trump is putting this plan forward and saying, listen, we take this seriously. We are all coming to Washington, D.C. When you say jump, we say how high, and we want to demonstrate our willingness to get this through. Their hope is that Putin is not being serious about this and that he will prove himself to be the obstacle to any kind of lasting peace and any kind of deal. But that is what the Europeans need to prove, and that is what Zelensky intends to prove.
Ollie Crook with the latest out of Europe. Ollie, thank you. Kelly Grieco of the Stimson Centre writing the following. Today's meeting will test Zelensky's ability to hold the line and to keep Ukraine's fate from being decided without him. Kelly joins us now for more. Kelly, welcome to the programme. How do we avoid a late February scenario? How do we avoid a repeat of that?
Yes, I mean, this has to be one of Zelensky and Europe's main concerns is that we'll see a repeat of this, what happened in February. You know, I think we're in a different place than we were in February. I think Zelensky is much smarter to not fall into sort of the traps that he did in February. And of course, the Europeans are going to be there to act as a buffer.
Kelly, what do you know about this security guarantee? They're discussing the NATO Article 5-like guarantee, but not NATO.
Yeah, so, you know, this is very vague. That's one of the things I would say about this summit. It was ended in sort of a cloud of uncertainty. And I see two possibilities for these Article 5 guarantees. One is that, Putin has actually accepted that Europe and the United States can provide some kind of Article 5 guarantee that if Russia were to attack again, that they would be obliged to respond, including militarily, to an invasion. I think that's unlikely. But the second possibility would be that it's actually something more like there were negotiations in Istanbul shortly after the war started, and there was an Article 5 type guarantee as part of those negotiations that Russia had accepted. And essentially all of the parties, the United States, the Europeans, and Russia itself would guarantee Ukraine's security. If one of them attacked, the others would respond. And I think that maybe that we're returning to the Istanbul formula. Of course, we don't really know.
Kelly, didn't they already make this agreement in 1994? What's so different from this than the Budapest Memorandum?
Yes, so it is different from 1994 when that was a security assurance. The states assured Ukraine, the parties to it, including Russia, that they would not attack. Of course, Russia has not abided by those terms. But there was no obligation in any of the language to say that if Ukraine was in fact attacked, others needed to provide assistance to support their defense. And a security guarantee does that. It actually says that there will be assistance provided in the event of an attack.
The perception after the meeting in Alaska between Vladimir Putin and President Trump was that this was a PR victory for Vladimir Putin. Do you think that there is anything that could happen today in this meeting with European leaders and Volodymyr Zelensky that could reverse that could change that perception and put a new spin on exactly how this carries out over the remaining weeks and months ahead?
Yes, I mean, it's certainly true that for Putin, this was a PR victory, before the talks even started, just being able to arrive on U.S. soil, no longer being, this isolated pariah, but sort of returning to being a statesman. I will say, though, today, I think the stakes for Zelensky and Europe are much higher than even, propaganda victories and PR victories. If I'm Zelensky, I'm arriving in D.C. not for this photo op, but because I want to be able to shape the actual peace process. I think we're now in the stage where this is really shuttle diplomacy. And so it's really up to Zelensky to really walk that needle of being able to assert and protect Ukrainian interests, but also making sure that he is able to keep Trump aligned with him to be able to represent Ukrainian interests with Russia.
How much of a sense do you have about Europeans' willingness to really commit, whether it's money, whether it's troops, whether it's their own guarantees behind any kind of peace agreement between Ukraine and Russia? Because that's been something that's been sort of contentious and contended between the U.S. and Europe.
Yes, I'm so glad you brought that up, because I think this is something that is often overlooked. Which is that, Europe talks a lot about wanting to provide some kind of security guarantee, but they're sparse on the details of what they're actually willing to provide in very concrete terms and how they're going to make that credible. And they face two challenges in this regard. One is that the decades of low defense spending mean that their military capabilities are more limited, particularly to be able to provide for their own security, as well as potentially for Ukraine's. And then the second is that this war's gone on for 3.5 years, and the Europeans have not been willing to intervene directly because they don't believe that they have sufficient interest to justify that level of commitment. So how do you make a commitment to potentially enter a new war should Russia attack credible when you've already demonstrated that you weren't willing to fight a war over Ukraine? Those are both really big challenges for Europe.
Kelly, Steve Witkoff said that important discussion will need to be had regarding Donetsk. What can Zelensky accept today?
Yes. So this is, this is the area where it's going to be the hardest for Ukraine. I think these Article 5 guarantees are meant to be a sweetener. And the reality is that there's going to have to be some level of territorial concessions if we're going to get to a peace deal. And it's clear that Putin is focused on Donetsk in particular, to try to capture the rest of Donbass. Luhansk and Donetsk make up Donbass. He has Luhansk under Russian control at the moment, or occupation. And he has about 87% of Donbass is under Russian occupation, and he wants the rest of it. And so I think, part of for Zelensky is he has to decide, is it better to do this at a negotiating table or to continue to fight? And it looks like if they continue to fight, the Russians will slowly and painfully be able to capture the rest of Donetsk. And so is it better to have options at the negotiating table so you can get some other kinds of concessions, whether it's other Ukrainian territory or also these kinds of security guarantees?
Kelly, just quickly, it might sound like a silly question, but why are we okay with Article 5 style guarantees but not NATO membership?
Yes, I mean, it's clear that NATO membership is a red line for the Russians. They do not want NATO membership, but this is also why I'm skeptical that the Russians are going to be acceptable with some idea of American or European forces, even in limited numbers, on Ukrainian soil to try to make that kind of Article 5 guarantee credible.
Kelly, appreciate your reaction to things. Thank you. Kelly Grieco of the Stimson Centre. I think a lot of people have got that question this morning.
I think if it's Article 5, you're expecting troops on the ground to be there, a presence in Ukraine. If it's Article 5-like, I think it's just a commitment verbally to be there if there was going to be another incursion. The problem right now is all of this is very cloudy and murky. This is a lot of rhetoric that's being tossed out. Contours of a plan is what I believe Secretary Rubio called it over the weekend. We need a lot more details to understand this.
I think most people are hoping we can avoid a repeat of the situation that took place in late February in the Oval Office. Up next on the programme, we'll catch up with Terry Haines of Pangaea Policy, saying geopolitics is in the economic driver's seat. Plus, Danny Berger with your morning movers as Soho House looks to go private. That stock is up by 16%. From New York City, you're watching Bloomberg TV. 2 weeks of gains on the S&P 500, a little bit softer on Friday. Likewise again this morning to kick off the trading week. We're down just 0.15% on the S&P, negative 0.16% 0.16 on the Nasdaq 100. With 3 hours until the opening bell, let's get you some morning movers. Let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Soho House confirming a Wall Street Journal report about 30 minutes ago that they will indeed be going private. The current shareholders will be taking the company private at $9 a share. We're not quite at the deal price yet, but shares are still up 15.5%. This is a company that has languished as a public company. IPO'd at $14, falling 45% through to today. It's a big day for take privates in general. Dayforce, those shares of 24%. The HR software group, Thoma Bravo, telling reportedly, Bloomberg sources telling Bloomberg that Thoma Bravo will be taking Dayforce public. This is another company that has struggled. It's down about 60% since the highs of 2021. Finally, Novo Nordisk ADRs in the U.S., those are also rallying some 5.5% this morning. They're getting approval for treating a rare form of a liver disease for Wegovy. That means that they have beat out their competition, Lilly, in bringing that drug to the market for specifically this use of treatment. BMO writing that this will help with much needed momentum after a tough start to the year for Novo Nordisk. John.
Danny, thank you. More from Danny in the next hour. Just on Soho House, isn't there some natural tension between a private members club being a public company?
Well,
isn't there just some natural tension there?
You could argue that this is the case for a private asset manager that also goes public, which has been something that we have seen repeatedly. But yes, I would guess that that would be something sort of odd because you're having to reveal the crown jewels of the privacy to the public in order to remain public. So you would think that they'd want to keep them private.
It's the thirst for growth that I think is where the ultimate contradiction is between, say, luxury, privacy and exclusivity, then going public and there's this massive push for growth. Who don't you know that's got a Soho House membership? You know, I remember like 20 years ago, Soho House was like kind of cool. And if someone had a membership, it was like, oh, that was very exclusive. Go down there now. It's like 25-year-old Instagram influencers, anyone and everyone who can get a membership to Soho House.
I think it was Groucho Marx who said, I don't want to be part of any kind of club that actually would take me. And there was something that is true about that with some of these private clubs that have to retain their cachet by remaining exclusive, but kind of are, you know, excited about the money.
A lot of complaints you could see on Twitter with this story that they've pretty much just let everyone that wants to come in, and that basically the standards have dropped in terms of what they're able to provide because they're just overrun with a ton of people.
Total sellouts. Let's see if it changes. It's brutal, right?
You want to be part of it? Do you want to join the Soho Club?
Let's see if it changes.
Would you have wanted to join the Soho Club?
That is not exclusive enough for me, Bramo.
Oh, yeah, I'm sorry.
You know that.
Okay, how many people need to be in your club?
It's like the Delta Airlines lounge of members clubs now.
But Delta what?
I'm just going to keep on digging.
Yeah, you're absolutely digging.
On our radar this morning, Ukrainian President Volodymyr Zelensky and several European leaders are meeting President Trump at the White House following his talks with Russian President Vladimir Putin in Alaska over the weekend.
So this is going to be a really high-stakes meeting for President Zelensky. He needs to decide what he's willing to accept in terms of what Putin laid out on Friday to the president, what we assume, because I was there and they didn't really give a tremendous amount of details. The statements that came out of Putin and Trump were pretty much pre-written, and they didn't take a single question from the press. On the other half of that, if Zelensky is able to get to some sort of agreement with the president, then they can go back to the Russians on territory that the Russians are able to accept. Is a security guarantee going to be enough? And what does that exactly look like? Which is why it's interesting the Europeans are in the room.
To me, what's most interesting is exactly that, how many Europeans are in the room, and the fact that they all got on their private jets and otherwise and flew to Washington in short notice. Again, let's just read the list. Georgia Meloni, Friedrich Merz, Emmanuel Macron, Alexander Stubbs, his bestie who plays golf, Mark Rutte, who has been running NATO but also has a positive history with President Trump. This, to me, indicates a level of unity in Europe that is very unusual. And I do wonder whether they're going to be presenting some sort of unified proposal to Trump to try to edify Ukraine's point.
I think there's been this idea in the press that they're there because President Zelensky might get bullied. What happened 6 months ago, that blow up in the Oval Office. But between February and now, there have been so many meetings between Trump and Zelensky, so many phone calls, a lot more than there's been, obviously, between Trump and President Putin. The Europeans have to be in the room. To provide security guarantees, they need to be there. And if things really go bad and you have to have these, quote, severe consequences, What did the secretary say to us, the Treasury Secretary Scott Bessent? He said when it comes to secondary tariffs to go after Russia and how they fund this war about their crude to China, well, the Europeans need to be on board for that. And right now they're not. And what do they continuously do? They are still importing Russian commodities. They are still taking in Russian gas. And actually, it's gone up. So they need to be in the room if they want to be able to settle this war on their continent.
Look out for the outcome of these meetings later on this afternoon. Look out for the outcome of the Federal Reserve get-together on Friday as well. This from the Atlanta Fed President Raphael Bostic saying consumers are growing more stressed and tariff costs are real. His comments coming after a meeting with bankers, educators and business owners in the Southeast.
Love the pictures of him in factories with earplugs in, trying to oversee the making of dog biscuits and toys. I do think it's interesting how much what he observed highlights the dilemma of the Federal Reserve, the dual mandate that is in conflict. You have high prices and you have consumers that are indicating that they are struggling. You have at the same time companies saying that they are struggling to find workers at the same time that households are struggling to pay their bills. This is not an easy situation for the Federal Reserve and doesn't lead to a clear answer, which is the reason why he said, I see the world today as having a lot of different possible outcomes. I don't think I have enough confidence about the probabilities assigned to the specific outcomes to feel like we can move definitively in one direction or another.
There isn't a massive incentive for Chairman Powell to signal anything on Friday. We've got another data point, payrolls early September, CPI the week after, and he's got a very divided committee going into that meeting.
And a highly politicized environment at a time when we've heard from President Trump and all of the people around him that they want a Fed rate cut. So if he's not incentivized to say anything, does he just give a 2-minute speech? We've set monetary policy. We're discussing everything. Thanks so much. See you next year. Or does he give some sort of new framework of a way that they're looking at it or looking at data to try to give some more informed view of their decision-making process?
When we were together in Jackson Hole back in 2022, I remember how jarring that 8-minute speech was. We sort of got situated, got a coffee, got ready to sit back for 20 minutes and try and catch our breath. Then the thing just abruptly ended. Pain, pain, pain. Back to you.
Yeah,
we're not getting that this time around, are we?
Well, last year was 15 minutes. That was the eight-minute
so it's getting longer.
Speech. So all I can say is if he goes longer, that'll give us a chance to go to the bathroom and grab a cup of coffee. But if
just
not,
thinking of you and TK,
I know.
that's all.
Thanks. That's really, I appreciate that. This was actually a very inside baseball moment when I was hearing you describe that because I reflected on the pain that I felt personally. Let's move on.
I'm going to move on. We'll get more data later this week. And by data, I'm talking about retail earnings ramping up through the week. Tomorrow, we're going to hear from Home Depot, Target on Wednesday, Walmart on Thursday. This is a really important read on retail in America.
Yeah. Do they see a weakening in the consumer? Are they catering more to the lower income consumers by cutting prices? Or are they upshifting some of their goods to try to sell to the higher income consumers that have really powered the entire consumer spending picture in the United States? Are these companies still the read on the economy that they have been in the past, or is that led by some of the smaller companies that we've seen struggling? Because ultimately, the Walmarts of the world have massive tech presences, have massive media empires, have massive shipping empires, and have the heft that a lot of smaller business really envy in terms of negotiating tariffs and terms with their suppliers.
Results from Walmart coming on Thursday. Look out for the big one later this week. The big story this morning is on Ukraine. The Ukrainian President Volodymyr Zelensky heading to the White House. Terry Haines of Pangaea Policy writing, geopolitics is in the economic driver's seat. Terry joins us now for more. Terry, welcome to the show. Just off the top, I just wanted to get your feel on how much pressure is on the Ukrainian leader going into this meeting.
No, there's been pressure on him for 3.5 years. But to me, the only thing that's changed really is that, you know, we're right down to the point where we're directionally in the next week, I think we're going to know whether we're on a path to peace in Ukraine or whether we're on a path to not peace in Ukraine. And for the markets, what matters there is not just the geopolitics, but also whether you see the return of secondary sanctions and the like. And I think that's probably quite likely should we go south.
Well, oil ended the day on Friday. I checked it, Terry, leaving Alaska lower. The market doesn't think we're going to get secondary sanctions. Is the market basically wrong here?
No, you know, what I told markets yesterday was that I thought the markets would probably be positive coming out of Alaska, and then oil was one of those indicators. And so far, that's been correct. But, you know, the markets are going to see with the European leaders flying in today, as well as Zelensky, you know, they're going to see positive strides towards peace that probably justify the continuation of lower oil prices. All I'm suggesting is that we get to a week from now And that may not be true anymore. Fundamentally, what we've got here is a situation where Trump and Putin started a process. The United States describes itself explicitly as a mediator in this process overall, but that Europe and China, I think, are going to be much more important. And, Europe needs not to be the coalition of the willing. It needs to be the coalition of the acting. And we're going to get to see in the next 7 days whether they are or they aren't.
Well, Terry, we went into the meeting, though, with the president saying there's going to be severe consequences if there's no cessation of hostilities. We all left Alaska with no ceasefire and no severe consequences. Why do you think in a week the president's going to change his mind?
I don't think he's going to change his mind. I think circumstances might well change his mind. I read the administration as jumping over jumping over the ceasefire into trying to get something lasting quickly. If there's anything we know about Trump, not the amateur psychology that we usually hear, anything we know about Trump, what Trump wants is to have real negotiations that have real consequences. In other words, that succeed or fail, and he wants to do that on a relatively short time frame.
Terry, not to interrupt, but that's what Putin wants. Putin wants to go to a peace agreement and work towards that, because without a cessation of hostilities, he continues to bombard Ukraine and can do so until there is a final peace agreement. Did he not just sway the president to his thinking?
I don't think he swayed the president at all, frankly. I find a lot of the Putin won the debate or the meeting to be a lot of pearl clutching. This is a guy who went, among other things, okay, this is a guy who went to the United States, didn't get to meet in a neutral country or anything else. This is a guy whose war aims are to take over Ukraine. Look at the different handle here. To take over Ukraine. So far, he has lost 83% of his war aims. And this is a guy that got buzzed by a B-2 bomber when he got off his plane. I mean, this is, to me, this is not a guy that's winning anything. The big question is whether or not the United States and the West will come together meaningfully and press that advantage in a way that gets Ukraine the most favorable terms possible. I think we know that directionally in about a week, whether or not the Europeans are willing to step up or whether they're not. I thought Kelly Grieco in the prior segment did a very nice job at the end there of describing all the ways in which the Europeans hadn't stepped up, as did you. So, I'm waiting for the Europeans here.
We keep talking about Europe. We keep talking about the U.S. What role does China, does India play in trying to bring Russia truly to the table for a lasting agreement? Russia is effectively a client state of China, in my estimation, and I've thought so for a few years now. And if China didn't want Russia to come to the table and have some sort of an agreement, then they wouldn't be doing so, number one. So I think China's okay with whatever scraps Russia can get. This is very consequential for Ukraine. I am not minimizing that. I'm just saying, whatever they think they can get out of the Donbas, China's okay. China's also okay with Europe tying itself into knots and showing that it's not a geopolitical force to be reckoned with, by the way. So, I think those are probably China's motivators.
Terry, thank you, sir. Terry Haines of Pangaea Policy. Terry, thank you. I think Europe's done a good job of that already, haven't they, over the past few years?
What, tying themselves in knots? Yeah, it seems like a consistent theme, which is a reason why I think it's pretty amazing that they all agreed on a date to come on Monday to coalesce in the White House.
You think they're worried about a repeat in late February?
Yes. Absolutely. I think they're worried about that, and they're worried about not being in the room, about being perceived as tying themselves in knots to such a degree that they're not even at the table of making an agreement.
I think also to your point, Annmarie, we can't make an agreement without them in the room.
Yeah, they're very relevant in terms of getting to the end game. You cannot have Europe not there, given the fact this is a war on the European continent, and whether or not you're going to get to a peace agreement with security guarantees, or whether or not it's going to be severe consequences on Russia, you need Europe for either scenario.
All eyes on that meeting in the nation's capital later on this afternoon. For now, let's get you an update on stories worldwide with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Air Canada has suspended its third quarter guidance and full year operating results due to a strike that's grounded hundreds of flights. But the airline does plan to resume flights this evening after the union representing flight attendants defied a return to work order Sunday afternoon. Meanwhile, China's Shanghai Stock Exchange closed at its highest level in a decade on Monday as investors continue to pile into the mainland market. The move cements a 20% turnaround since the sell-off in April tied to U.S. tariff announcements. The rally reflects a rising sense of optimism among small investors who are rotating out of bonds and into stocks. And I'm sure you were watching this one, John. Scotty Scheffler pulled off an incredible shot to win the 2025 BMW Championship yesterday. The world's #1 landed a wild chip in on the 17th hole at Caves Valley in Maryland. The two-shot win over Robert McIntyre was Scheffler's 5th of the season, becoming the first player since Tiger Woods to win at least 5 times on the PGA Tour in consecutive years. That's your Bloomberg Brief. John?
Yeah, Hara, thank you. Even with some sloppy putting along the way, just missed a consistent grinding it out. Felt bad for Bobby McIntyre. Just a taste of the Ryder Cup in a few weeks to come. Chance of USA around the golf course over the weekend.
All I can say is I love it when you talk to yourself about golf after we hear from you, Hira, because that's essentially what you're going to be doing. I could pretend.
Both of you always give me the impression that you want to weigh it.
Well, I didn't say anything.
To engage the camera and carry on talking to myself.
It's always really funny that
Not
golf. It's always sort of this. I'll come up with something next time. I'll act passionate.
Everybody here is super excited for the Ryder Cup in a month's time. Up next, Chair Powell in Jackson Hole.
We know that the economy barely grew over 1% in the first half of the year. And so a 4.33% Fed funds rate is just too high for the economy that we have right now.
In just a moment, we'll catch up with Neil Dutta of Renmac, live from New York. This is Bloomberg. Snapping a 3-day winning streak in Friday's session on the S&P 500. Small pullback. A repeat of that again this morning. We're down by about 0.1% on the S&P. Likewise on the Nasdaq 100. Under surveillance this morning, Chair Powell in Jackson Hole.
We know that the economy barely grew over 1% in the first half of the year. And so a 4.33% Fed funds rate is just too high for the economy that we have right now. You have the scope to cut by 50 basis points. And then after that, you'd have to look at the data and you'd have to look at the markets and you have to look at what's going on in the real economy and put it all together.
So here's the latest this morning. Investors bracing for Fed Chair Jay Powell's speech at the Fed's annual symposium in Jackson Hole. Neil Dutta of Renaissance Macro Research writing, don't expect a strong signal. Neil joins us now for more. Neil, welcome to the program. Let's start with the labour market. Is this a labour market in transition?
Well, I think so. I think if you look at things like underemployment, discouraged workers out of the workforce, college unemployment, black unemployment, these are, there's clearly some weakening in the jobs market, leaving the slowdown in payroll growth aside. And to me, what's important about it is that it really undercuts this argument that a lot of hawks are making that the slowing in the jobs market is largely a supply-driven phenomenon. Did we have a bunch of college graduates swarming across the border over the last 3 years? So I do think that demand is the principal reason why labor market conditions have slowed, and that's something the Fed ultimately will need to respond to.
Is it problematic for you that stocks are at all-time highs and that corporate bond spreads are at the lowest level since 1998 at a time where you and others are making the argument that the economy is weakening to a significant degree?
If financial conditions are actually this easy, why is it that lending standards in the Fed's own senior loan officer survey continue to tighten? Why is it that housing market conditions are weak? I think the argument is essentially conflating financial market conditions with financial conditions for the real economy. And the Fed needs to respond to what's actually happening in the real economy.
Does it complicate, though, the Fed's messaging at a time where the economic data has been somewhat conflicted? There have been questions about the integrity of it just by virtue of how many people respond to these surveys. And you have a highly politicized environment with the president continuing to jawbone the Fed to cut rates significantly.
No, there's a lot of noise and uncertainty, but it's also the Fed's responsibility to make decisions under these difficult circumstances. I think that's the tension that the chairman has to deal with. I don't believe that the Fed can cut 50, so it's kind of pointless to even talk about it. You have to basically understand where the other people on the other side of the argument are. I mean, basically, you have a Fed at the moment that is split between people that think they should cut twice and not at all. So it's really hard to just move the Overton window and be like, yeah, let's go 50. I don't think that's going to really persuade people. So you have to kind of, pick the battles wisely. And that's why I think going 25 makes sense as an insurance policy, essentially. I mean, if the labor market deteriorates further, then the Fed can get more aggressive. But if you're calling for 50 right now, I mean, I think what you're basically saying, that's really a call option on another really bad jobs number. So, you kind of have to see it before you can kind of commit to it.
Neil, that's what the Treasury Secretary is calling for. Does he think the economy is worse than you think it is?
No, I think he thinks the Fed is more behind than I think they might be.
When it comes to the Treasury sector, Jim Bianco is putting out this argument that Bessent is providing filler names, basically, and that maybe his argument, potential speculation, is that Trump's already cut a deal with Bessent to take the job for next year. What do you think of that kind of argument as you track who is going to be the new Fed chair?
I mean, the Treasury Secretary said repeatedly that he's in the job that he wants, and that he's been offered the job and said no. So I would take him at his word. In terms, what we are seeing is a flood the zone strategy. I mean, the president said very clearly that there's what, like 3 or 4 people that he's actively considering. And, I do think perhaps a lot of these other names are just kind of flooding the zone to advocate for 50. Folks like Lori Logan, you had up on your screen, she's a voter next year. Maybe if she thinks she might have a chance at the job, maybe she'll start advocating for 50. I mean, I don't know. I think, most of these people that are up there, they're not going to fall for it. And I don't think the market is either. But I do think it's an interesting strategy of getting additional people to kind of come out and support a more aggressive rate cutting path up front.
Neil, just before you go, got about a minute left. Just time for, I think, an important question. You've called this economy really quite well. You've talked about a slowdown that actually started at the end of last year and continued into this year with regards to the labour market. The chairman has anchored his view around the headline unemployment rate. You've raised questions about that. How are you anchoring your view? What are you focused on?
Well, I'm focused on a number of factors. When I talked to them, I highlighted them. I think it's important to look at a wide body of indicators and, the Conference Board labor differential as an example. So what are consumers telling you about labor market conditions? They're telling you they're getting worse at the margin, that jobs are getting harder to get, jobs aren't plentiful. Historically, this has had a strong relationship to what actually happens with the unemployment rate. That's not surprising because people tend to see things in their own local economies before the data actually picks up on it. Or small businesses. I mean, there was a lot of enthusiasm around small business sentiment rising, but look at what small businesses are telling you about sales, that they're citing that as one of their single biggest problems, weak sales. And so historically, again, when that happens, you start to see unemployment going up. And then looking at the employment data itself, I mean, look, we can talk about lower break-even rates all you want, but I don't think a lot of people had like sub 50 on jobs on their bingo card in the second quarter, okay? And that's kind of where we are right now. And you have to ask yourself, like, where are we going? And I do think it's probably weaker from here, particularly with respect to housing-related industries.
Neil, appreciate your time. As always, Neil Dutta of Renmark on the slowdown he sees in the economy and the need, he says, for this Fed to act. From New York, the second hour of Bloomberg Surveillance, up next.
We fell because of the tariffs. We had this big sell-off, and we've now recovered.
I think this momentum is real.
This is an interesting inflection point. There's potential for upside.
This is not a particularly screamingly broad rally.
I think the markets are starting to conclude that, uncertainty is going to be with us here for a while. Let's move on with our businesses.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. Your scores look like this so far this Monday morning. Equities pulling back just 0.1% on the S&P 500, down 0.1 also on the Nasdaq 100. Anticipating this week right here, it starts down in Washington with a get-together between the Ukrainian leader and President Donald Trump. As the week advances, the focus on retailers grows. Home Depot tomorrow, Target on Wednesday, Walmart on Thursday, and then the big one of the week for markets worldwide is Chairman Powell in Jackson Hole.
It perfectly sums up the conundrum for markets right now. Essentially, you're going to have companies come out, possibly tell you that they're doing better than expected, like all the other companies that have come out, or the bulk of them, talking about how profitability has exceeded expectations. That has been what we have seen so far. And then you're going to hear an explanation from the head of the Federal Reserve about why they are or are not cutting when the market's baking in more than 100 basis points of rate cuts between now and the end of next year. Try to square this circle. The idea that you see real strength in the underlying economy as represented by corporate America. But when you hear anyone talk about the Fed, they talk about the need for more accommodation.
Whether it's Zelensky or Chairman Powell, those two individuals under pressure from this president, the president of the United States.
And for today, it's going to be Zelensky. President Trump made it pretty clear leaving Alaska. He spoke to Sean Hannity after basically we're all scratching our heads in Anchorage. Why didn't he take questions? This is a president who has the propensity to constantly want to brief the press. And why did they not have an extended bilateral meeting? What happened exactly? What is Zelensky going to be put in front of him today? The president says it's now up to him to get it done. He has two issues at play. One is territory, which is really the third rail when it comes to issues politically back home for Zelensky. And then these security guarantees. Giorgia Meloni talked about this months ago. Now it looks like they have this concept of an idea of a security guarantee that's Article 5 NATO-like, but not NATO. And everyone is dying to know what actually are the details of this.
We jumped a phase, didn't we? We jumped a step. We've gone from ceasefire talks to a full peace deal and a real acceleration of the process.
Which some people say is probably a bad sign, because without a ceasefire, there is this feeling that maybe Russia could gun it into Ukraine and try to get more territory. A real question here about how much more leverage Putin has gotten and whether he's just buying time as he has done before. I'm just wondering about Europe's role and their ability to get to the table as quickly as possible, and how much this is really a pivotal moment for them to remain a really central player in the global stage, because ultimately that seems to be what's at stake here.
We all want to see peace, and I think we all need to give this space to play out, this process to play out through the weeks ahead. But I do have an obvious question. Why are we okay with Article 5-like security agreements, but not Article 5 agreements within NATO? What's the difference between the two, and what does that tell you about one versus the other?
So it's a wonderful question. If there is no difference, then essentially why would Vladimir Putin agree to it? If there is a difference, why does it provide any protection to Ukraine whatsoever? Because if it isn't really a concrete deal offering protection, how does Vladimir Zelensky have that assurance that they will come to his rescue?
It feels more like rhetoric. I think for it to be Article 5 and actually for Ukraine to be admitted into NATO, that is a red flag, according to Steve Witkoff, that Putin said behind closed doors, and he's been saying for years. For it to be Article 5, likely you have to have boots on the ground all the time and much more of an integrated process between Ukraine and NATO members. If it's just Article 5-like, it sounds like it's some agreement that you're just going to sign on the dotted line that is some vague security assurances. My question is, how is this going to be lasting? Can this actually have the threshold of be continuing throughout multiple U.S. presidencies in the future?
Big focus on the nation's capital later on this afternoon. Big focus on this market through the week. Equities close to all-time highs, pulling back just 0.1% on the S&P so far. Coming up this hour, we'll catch up with Drew Pettit of Citi as stocks pull back from all-time highs. Henrietta Treyz of Veda Partners as the Senate confirmation process backs up. And Patrick Moorhead of Moor Insights and Strategy ahead of new tariffs on semiconductors. We begin this hour with Stock Steady as investors face down a week full of event risks. Drew Pettit of Citi writing, when markets see a not too hot, not too cold economic data backdrop, performance broadens. Any macro concerns or policy uncertainty upticks ends up leading to more of the same. A growth-driven market. Drew joins us now for more. Drew, welcome to the program. Which market are you positioning for?
So short term, we're sticking with growth here. Look, at an index like high level, if you're thinking about high beta, we like NASDAQ over Russell right now. when you think about operating leverage, margin expansion, who can really get through cyclical uncertainty, it's a lot of the growth and AI-driven names right now. So near term, we're going to stick with growth.
Drew, let's talk about the other companies, the cyclical players. When we speak to economists on this program, they talk about building growing evidence of margin squeeze. Drew, do you see the same thing across the companies that you look at? And what are the levers they have available to them to offset that in the months to come?
So we actually agree. That's where you're seeing the margin compression, or I would say even margin stickiness if they have low margins. When you don't have a lot of margin and there's uncertainty or policy changes, there's nothing you can really eat. You either have to pass that through and that could hurt demand, or if you do have some, you got to kind of give it up just to kind of keep some share. So it's been messy for the cyclical side of the market, and that's where you've seen a lot of downward revisions. When we started the year, there was only about 5% of the companies in the S&P that were expected to have negative earnings growth. Fast forward to today, that's almost 30%. So that's been a massive headwind and why we really haven't gotten broadening to this point.
If you put this together, Drew, it points to something we've been talking about and hinting about all morning, which is the big are getting bigger and are in a stronger position. And we're going to see that probably this week with the likes of Home Depot, but more importantly, Walmart. How much does this just broaden the division in performance between the small cap universe, which has underperformed for decades now, and the large caps, which might be poised to continue to outperform based on their ability to negotiate contracts, based on their ability to adapt to the new AI landscape?
So this is kind of the beauty. A lot of what we're talking about now might actually be the backward looking. The one thing that has changed in the last month when we start to think about 2026, and markets increasingly and investors are starting to think about 2026, is the One Big Beautiful Bill Act. So that should actually help a lot more of the cyclical names and some of the names that probably had been hurt more by tariffs. So you finally get a little bit of an offset and the compares are getting a little bit easier. So yeah, all these companies with tons of free cash flow have been able to develop their businesses and take some different shots to change businesses that have really helped them. Going forward, it should narrow. You should finally get some less negative or earnings growers. That should probably help with participation. Will it change leadership? Not sure we're there yet, but maybe finally we can start talking about the Russell finally going up rather than just bouncing off the flows.
How much does that really hinge on whether or not we get rate cuts?
That's definitely part of it. From the performance perspective, we've been saying this for a long time about small cap. It's not an either or. You need both better economic data and lower rates. It's really twofold. You know, a lot of these companies, higher interest rates, depreciation, amortization, that's really hurt because they haven't had operating leverage. So lower interest rates, more access to capital, down cap and in cyclicals can definitely help them change businesses and get some more productivity gains in margin expansion, which honestly, that's what markets want right now in single stocks.
Drew, when you're looking at margin expansions, can businesses pass on the costs of tariffs to consumers?
It depends. This has been messy and honestly something we've had to look at sector by sector. The growth names and anyone tied to any type of tech or secular trend has been able to either get margins by productivity enhancements or gain share because they're just better businesses and experiences for their customers. Outside of that, it's been really, really tough to see anyone really have any positive operating leverage and be able to pass on costs.
So if they're not able to pass on costs, but they have to cut costs, Drew, what are they going to
do? You end up kind of surviving until you can get out the other side of what feels like an early cycle environment. And guess what's early cycle? Economic data finally bottoming and rates coming down. And that's a broadening thesis. And that's probably a healthier leg of a bull market. That's something we can see coming in 2026. It's just how early do markets turn? Again, short term, growth names, probably a safer trade to be in if you're looking for some beta. Next year is when the thesis around broadening gets a little bit more real, at least fundamentally.
Hey, Drew, appreciate your reaction this morning. Thank you, sir. Drew Pettit there of Citi on the equity market. So strange to have this conversation about tighter margins and an economic growth slowdown with high yield spreads as tight as they are and investment grade spreads as tight as they are.
If you look at margins in many industries, they're not shrinking. This is the irony. You talk about margin compression, you're seeing it with PPI versus CPI. But when you take a look at what's actually happening for S&P 500 companies, they're not compressing all that much, and corporate strength is all the better. It raises the question, is Scott Bessent correct in saying that margins are just normalizing post-pandemic? Or does this indicate that it's being felt elsewhere? Read smaller companies that are the ones that possibly would benefit by cutting rates. Look, the reason why this sounds confusing is because it is. And there are lots of different tiers. And it's the reason why it's going to be very complicated to put it together with one cohesive monetary policy.
Torsten Slok over the weekend of Apollo writing this: solid macro and corporate fundamentals coupled with persistent institutional demand and limited net new supply have anchored credit spreads and performance. Speaks to everything we've seen over the past few months.
And maybe the $7 trillion on the sidelines that people talked about, which I know I can see you rolling your eyes. And I agree with you because it's not in the sidelines. Because it's cash and it's actually giving 5% or 4.5%. That's actually pretty good. So maybe it's not on the sidelines, but it's still there. So maybe it's rolling in.
It's a wall of money that steps in every time we get any kind of backup in spread. Every single time. Elsewhere in the equity market, futures slightly softer. We're down by about 0.1% on the S&P 500. With an update on stories worldwide with your Bloomberg brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. President Trump will host Ukrainian President Zelensky and European allies in Washington today to set out terms for a potential peace deal with Russia, with the focus on territorial concessions and Kyiv seeking security guarantees. This after President Trump and Putin met in Alaska with little revealed in what was discussed. Meanwhile, White House trade advisor Peter Navarro is out with some strong criticism of India's use of Russian oil, calling the purchases, quote, opportunistic and deeply corrosive in the Financial Times. Navarro went on to say India needs to start acting like a strategic partner of the U.S. if it wants to be treated as one. And English football is back with the Premier League season starting with a busy opening weekend. Liverpool, Tottenham, and Arsenal are off to strong starts after winning their first matches. The new-look Manchester United squad failed to find a spark and get on the score sheet, while Manchester City and Sunderland also came away with wins after holding their opponents scoreless. That's your Bloomberg Brief. John?
Yahara, thank you. Dear AC Milan. When you have one of the world's best midfielders, do not sell that player at the start of the transfer window to one of the richest clubs on the planet for peanuts, for nothing. The debut of Tijani Reinders over the weekend, just absolutely phenomenal. And I think if you are a Milan fan over the weekend, you were shedding a tear for how much little money was raised at Milan and how little has been spent over the transfer window to compensate for it.
Would you like to sign your letter? Love, Jonathan Ferro.
I don't know how much love is left.
I mean, honestly,
don't know how much love is left.
All I can say is English football never left, because ultimately everyone has a team and everyone has a league, and it feels like this is like the new slave labor. They're just compensated a lot for it.
They've been playing a lot of football, haven't they?
It's crazy. Yeah. I mean, can you imagine?
Don't worry, they get paid a lot too.
I know. It's not exactly slave labor.
Smallest violin on the planet, right? And all that. Yeah, something like that. Up next on the programme, the confirmation process.
I'll be naming a new chairman sometime within the next, I think I'll name it a little bit early, the new chairman. I'm down to 3 or 4 names, all good, all great.
We'll talk about that process in just a moment with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Equity softer this morning, down 0.1% on the S&P. Likewise on the Nasdaq 100, down by 0.1% so far this morning. Under surveillance this morning, the confirmation process.
We call him Jerome Too Late Powell. It will live with him forever. I believe that name will live with him forever. I'll be naming a new chairman sometime within the next, I think I'll name it a little bit early, the new chairman. I'm down to 3 or 4 names, all good, all great. The problem is you name them and then they turn out to be not good. That's happened to me a couple of times.
It's the latest this morning. President Donald Trump looking to put his stamp on the Federal Reserve and the BLS with Congress on August recess. Both White House economic advisor Stephen Miron and Heritage Foundation economist E.J. Antony will look to be confirmed on Capitol Hill. Bloomberg's Mike McKee has the latest. Mike, welcome to the programme, sir. I think we're all asking the similar question, just how quickly this confirmation process can be conducted.
Well, ordinarily, it can't be conducted very quickly because people who are nominated have to fill out extensive financial disclosure forms, and then they go around on Capitol Hill and meet with senators privately to sell their nomination. The senators do their own investigations, the committees do. So it can take months. In this case, there's going to be a big push from the president to get Stephen Miron in by September 17th. That's going to be tough because the Senate doesn't come back until September 3rd, and they have only 10 legislative days of work in Washington before that September 17th meeting. So they would have to set some sort of speed record for the Senate in getting him confirmed in that time frame. I don't think that it's going to matter much with Antony. The BLS will continue to produce the data whether or not he's in place, and his nomination is going to be a lot more controversial. So I would expect his to take some time.
Mike, just a final question from me. You're in Jackson Hole already, ahead of the annual get-together for the Federal Reserve. Are they going to tackle these issues of data reliability, data dependence? Are they going to tackle these issues of institutional independence? Are these things going to come up?
Probably not in the sessions themselves. We will certainly be asking members of the Fed and others about it when we are up at Jackson Lake Lodge. The issue is there's really only one public-facing kind of speech, and that comes from the chairman. And I don't think he wants to go anywhere near those issues. He'll be talking about the framework we expect and maybe giving some hints about whether they're thinking of cutting rates in September. But the rest of it is probably not going to be something that is widely discussed.
Mike McKee with the latest in Jackson Hole. Mike, thank you. We'll catch up with you a little bit later. Joining us now, Henrietta Treyz of Veda Partners. Henrietta, I believe the next Fed meeting is September 17th. Will Stephen Miron be there?
I would be really surprised. There is not always an advantage to being a Senate nerd, but every once in a while it's really convenient. And this is an opportunity where we know that as soon as the senators get back from their month-long recess, they're going to start debate on the National Defense Authorization Act. And once we move to that on the Senate floor, it can occupy weeks of time. So getting a confirmation for somebody who hasn't gone through the motions yet, with the committees not even in session, is actually going to be incredibly complex. And I think that there is a lot of reason to anticipate that the senators are also going to be trying to work with the other 10 or so votes we're going to need from the Democratic side to keep the government going into September 30th. They're going to have questions about why the Russia sanctions package isn't going into effect. The president has threatened these secondary tariffs on India, but they haven't actually put them on. There's a lot of competing factions and some wars happening that include Republican senators that could delay the approval of any of these nominations for several months to come.
Henrietta, how much pressure right now is the White House putting on the Senate when it comes to Steve Miron to try to get his nomination through before the Fed meets?
I think it's very minimal, just in terms of understanding that the opportunities for the president to continue pummeling Powell are actually very convenient for the president. The more he can lambast the Federal Reserve, the better for the president personally, especially as we get additional inflation data and these tariffs from August go into effect. So I think there's a pretty valuable sort of punching bag in the Federal Reserve right now. And being able to continue to hammer that and say, we want our guys in there, they're not there yet, is in maybe everybody's best interest from the White House perspective.
When it comes to the BLS commissioner nomination, E.J. Antony, there's a 51% chance, according to Kalshi, that he gets through. What do you put the probability as?
I think it's going to be lower than that. I'm a pretty econ-focused person generally, especially on the Hill, and the unanimity behind opposing this proposed commissioner is really alarming. As you guys know full well, economists don't always agree on a lot of things. In this case, it's pretty much unanimous, very outspoken, from really trusted resources, from conservative think tanks, from conservative economists saying this is just not the guy to have continuity of confidence in the data. And I think that there are a lot of senators who would like to advise and consent on this in a way that gets somebody in there that's less polarizing. it's not going to be ever a first-tier concern. Bureau of Labor and Statistics is not where they spend an inordinate amount of their time, and we could very well be walking into a government shutdown. But I think they're very happy to delay. 51% odds seems high to me.
So Congress takes a lot of vacation time, and we talk about this a lot, and they have their August recess right now. We're all jealous. It sounds very European. How many of them go back to their constituents and actually hear what people are saying about tariffs and about the labor market and about the current situation? How much will that change the way they act when they come back to Washington, D.C. in September?
I think it's most relevant for the House members because they're up for re-election and only a handful of the senators are. And the senators who are inordinately exposed to election risk have already said that they're quitting. Tom Tillis of North Carolina has decided not to run again over the one big beautiful bill. I will say that wherever I go, I ask about tariffs. If I'm standing in the grocery line, I turn around and ask people, this whatever about tariffs. Every single person in America is familiar and has an opinion about tariffs, and it's pretty universally negative. 87% of Americans are concerned about the inflation that will come from tariffs per the latest Gallup poll. So it's a pretty easy conversation to have, and I think most members would like to stay away from it. What the Republicans are really focusing on is selling the one big beautiful bill and things like no taxes on tips and pieces along those lines that they think they can message in a positive light to their constituents.
I have to say, I'm thinking about you in the grocery store line and people saying, there goes that woman again. Before we let you go, I do want just a word on what you expect to happen today in Washington, D.C. Very much the focus is on Volodymyr Zelensky, the coalition of European leaders coming to speak with President Trump. What are you expecting to learn from that meeting?
Well, first of all, I'm a delight in a grocery store, and I would just say that it's fun to talk about tariffs. No, I'm just kidding. When it comes to today, I think that what's happening is the United States has an inordinately low gas price right now, which I think is really interesting. I was out in Raceland, Louisiana last weekend, and it was $2.47. The Trump administration is in a position to impose these sanctions from a domestic standpoint, given where gas prices and oil are today. And the fact that they are not indicates pretty clearly that they're not going to put the squeeze on Russia. So I think that is why the European leaders are coming over in such haste, as y'all were pointing out earlier, to make sure that they're involved in this conversation. They don't leave Zelensky hanging in the wind alone like he was last time. But I think we're still a ways away from any kind of full-blown ceasefire or any kind of peace deal. I think this is obviously in President Putin's best interest to continue that pace. And the India sanctions, the most that I'm expecting in the weeks ahead, not on China, and probably not on anywhere else.
Yeah, let's just build on that. Peter Navarro talked about the same thing. Is there an obvious interplay right now between, say, Russia, sanctions policy, and the approach to tariffs?
Absolutely. It's so obvious from just the way the president speaks to it, calling them secondary tariffs instead of secondary sanctions. I think what's most telling is the way in which the president has decided to impose the sanctions on India. They're not tariffs. They're not sanctions the way that they ordinarily would be. They're tariffs on all the goods that he's imposing tariffs on under IEEPA. So he's actually evading the strategy of sanctions, which is to target specifically your arms dealers, your arms defense industry, oligarchs, people that you would ordinarily target, financial institutions, just for a sanctions process. And instead, he's using the IEEPA tariffs. And I think there is absolutely an interplay there. And most notably to me is President Trump's resistance to imposing a broad sanctions package that would penalize Russia in a meaningful way. And there's a couple things, most of which is the president of the United States cannot afford to escalate the trade war with China at this juncture and still hope to have a meeting in the fall, still hope to have trade between the two nations. It just can't be done. And so he's hamstrung on India, which is why Navarro is highlighting it.
Henrietta, appreciate your time. Henrietta Treyz there of Veda Partners. Peter Navarro in the Financial Times this morning. American consumers buy Indian goods. India uses those dollars to buy discounted Russian crude. Up next, new chip tariffs on the horizon. Patrick Moorhead of Moor Insights and Strategy joins us in just a moment. Quiet start to a busy week. This week we start lower by about 0.1% on the S&P down by 0.16 on the Nasdaq. The busy week I'm talking about, retail earnings kicking off with Home Depot, Target and Walmart. That starts tomorrow morning, concludes on Thursday. Busy week down in Washington as well. It kicks off later on this afternoon with Volodymyr Zelensky sitting down with the President of the United States, and a busy week for the Federal Reserve. That concludes on Friday with Chairman Powell in Jackson Hole, Wyoming. As we count you down to that opening bell, 2 hours away, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. For a second trading day, we're seeing a lot of the clean energy stocks rally. That was after Friday when government agencies issued new guidance when it comes to solar tax credits. The large outcome of that, less onerous than was expected. So Sunrun, for example, that's up 3.3%. RBC also upgraded that stock this morning, saying that what we got from the government removes a lot of the uncertainty for solar. Those shares up 4%. Elsewhere, Novo Nordisk, those ADRs are rallying thanks to its Wegovy got approval to treat a rare liver disease. The issue, though, for Lilly is it got to market before them. So Lilly was lower this morning, but still down by about 0.5%. Of course, Novo Nordisk has been languishing this year, a lot more competition for its obesity drug. In the last hour, we also learned that Soho House would be going private. They confirmed an earlier report from the Wall Street Journal. Its current investors will be taking it private for $9 a share. We're not quite there. Shares are rallying 16%. John, you talked about the tension of a private members club being public. Of course, the real tension is any of the bankers who work on this deal won't be allowed to be members of Soho House.
Haven't they started to adjust those rules? I know plenty of people, Danny, have got around that, don't you?
Yeah, but I mean, they lied to do it, right? They're not like, oh, I'm a banker, I'm a, executive of a fancy art company or something like that.
People who work in banks are the least of their problems right now. Danny, thank you. Danny Berger, thank you. As some might say, the Delta Airlines lounge of the private members clubs.
Okay, all I could say is I'm really not feeling bad for this. This is Groucho Marx moment, right? I wouldn't want to be a part of any club that would have me. And so at a certain point, there is this natural tension between expanding a club that is by nature exclusive.
It's too overrun. You're more of a 5 Hartford Street guy.
Thank you. Appreciate that. It's a good club.
Yeah, it's a good club.
Okay, we'll move on.
I know a few members.
Of course. On our radar this morning, President Donald Trump hosting Ukrainian President Zelensky and European allies in Washington today. It set out terms for a potential peace deal with Russia. The leaders set to focus on territorial concessions, with Kyiv seeking security guarantees.
So to me, this is going to be a pivotal meeting to really understand exactly how realistic it is for them to get some sort of peace agreement at a time where ceasefire doesn't seem to be the main precursor to any such agreement. If you don't have that, will Russia really stop trying to get more land ahead of negotiations where essentially the United States is backing Russia's argument for Ukraine to give up some of its land?
Whatever we call it, ceasefire, peace deal, a cessation of hostilities was supposed to be the start of a process. And now cessation of hostilities is the end of a process, which is why many critics think that in the end, Putin won, at least on that front, because he can continue bombarding Ukraine and at the same time say that he's part of this process to wind down the war. The president in Anchorage, and I was there, made it very clear there is no deal until there's a deal, which means he has to get Zelensky on board. Now, Zelensky's going to take a big step forward today, as opposed to his Oval Office blow up in February when it comes to at least a discussion on security guarantees, this NATO-like Article 5 security guarantee, along with European leaders having his back. But when it comes to the territory, this is where it's going to be incredibly difficult, because what Putin is asking for is part of a region, parts of it, that Ukraine actually has men there and troops there, and not just a front line. They've actually fortified cities, and it's become their main front line to Russia. And without that, after that, there's just basically fields, and it gives them an open wide for the Russians. This is why it is so difficult for Zelensky to accept.
And that's the latest on Washington. Look out for those meetings later on this afternoon. Here's the latest on the Federal Reserve. The Fed in focus this week as the Jackson Hole Symposium begins on Thursday. All eyes on Fed Chair Jay Powell's remarks as he's expected to signal the Fed's thinking ahead of the meeting in September.
Is he? Though this is the question. Is he expected to really signal, will they or won't they cut rates in September? This is sort of the big question. There's that. There's how much does the Fed push back against any kind of political interference? Expect none of these questions to be answered. Instead, it will be an academic discourse on the labor market and the nature of changes and artificial intelligence and immigration and how you measure inflation. And it might be a lot of jargon, because why wouldn't they? Why do they want to weigh in at a time when there is such a lack of certainty around the economic data? Yet that is what people are hoping for.
You sound like someone who's cancelled their flight.
I have not canceled my flight.
You
I'm
haven't
actually
cancelled the
excited to
flight.
have. I'm actually excited to have these discussions, and I'm excited to go for a hike because I like hiking, and I really enjoy the Grand Tetons, and I do find it really cool that all of the different Fed officials and even global leaders.
Good save.
They all
just
go for
paying
hikes.
for you to go hiking at Jackson Hole.
Yes.
Is that what this is?
Hold on a second. Absolutely not. I'm going to have really substantive conversations.
For the record, I didn't go
with the
hiking
bears.
or bear watching in Alaska. I
look
came
at that.
right home
You're
to make
so-
sure I was on the show today.
All right.
Good save, Bramo. If management's watching this morning. OK. The device war is heating up as foldable phones gain traction. According to NBC News, Samsung's smartphone market share rose to 31%, while Apple's declined to 49% for the second quarter of all the companies, the big companies on the S&P 500 right now. This one in a really tricky spot.
So Apple doesn't have a foldable phone, and they're behind on AI. The idea that Samsung is making inroads at a time where Apple is also challenged by some of the tariffs and where the production lines are coming from really highlights why there is skepticism and why you have seen the shares of that company down 7.5%, even though Samsung shares are up about 35% so far in 2025. It feels like people are waiting for a shifting in the guards. You also see Samsung playing with tablets that aren't just a square or a rectangle, that are flat. They're also looking for other potential shapes. Do we get a circle? Do we get goggles? Do we get maybe a wristband? And these are the things that Apple has really avoided until now.
Innovation. We'd like to see some, wouldn't we? Sometime soon, anyway, from Apple. Let's stick with tech. President Trump saying he would set levies on semiconductors in the next 2 weeks, suggesting the rate could be as high as 300% on imported chips. Patrick Moorhead of Moor Insights and Strategy saying, I do not believe when the smoke clears, the administration would apply large tariffs on chips. Patrick joins us now for more. Patrick, welcome to the programme, sir. Let's get to why. What underpins that statement, sir?
Well, we've seen a lot of threats that have made from the administration, and then nothing happens. It's been derogatorily called taco, but the reality is that the administration doesn't want to tank companies like NVIDIA or Apple, and it actually disincents final product assembly here in the U.S.
Really difficult to navigate this moment, Patrick, as you know, because the other topic we discussed just last week is that the money they're using for the CHIPS Act, they might try and use to take an equity stake in Intel. We've got all this heightened intervention, the prospect of tariffs, the prospect of a revenue share if you're selling into China, the prospect of an equity stake sale from Intel to the government. Patrick, how are you suggesting investors navigate this moment in this industry?
Well, I think they do a best case, worst case, and what's likely going to happen scenario. But the reality is that none of us knows what's going to happen. What I am very confident in, though, is the U.S. government will take a stake in Intel and will choose it as a national champion for some of the hyperscalers and some of the big chip makers to manufacture their chips on, because it's about national security. And it's not unprecedented for the U.S. government to take equity stakes. They did it in GM, Chrysler, even Palantir, and more recently MP Materials. And MP Materials is probably the best case or the best case study to see how the government might do that, where they take an equity stake, they take a portion of the profit. But I think there's going to be carrots and sticks involved as it relates to companies like NVIDIA and Apple. And with Section 232, which is about national security, which there's a report that should be completed any week now, that gives Trump the out to go and renegotiate things that may have been considered complete. So, for instance, the agreement with Apple, the agreement with South Korea.
Is government intervention a positive thing for investors at a time when there's a whole method of carrots and sticks?
In macro, no. But we also have to recognize when it comes to advanced chip making, and even more importantly, advanced chip making intellectual property, Taiwanese government gave TSMC almost half of their initial funding. They currently own 6%. I don't think in the long run, interventionism works, because you get the government involved in anything, it tends to slow down. But for a lifeline out there for something that is this important, I do not think the U.S. government is going to let Intel Foundry or Intel Foundry intellectual property go away.
Too important to fail. You said there's likely going to be some forms of carrot and sticks. So we have this intervention potentially for Intel, basically telling all the companies that use chips, you have to use an Intel Foundry. At what point will we get Intel manufacturing at the level we're seeing from TSMC?
So there's two ways to look at it. There's the sophistication of the technology, and then there's the amount of, let's say, wafers that are done, which is the core output of what TSMC does. Right now, I guess on the plus side, Intel's 18A and 18AP look competitive. They're a tad, quote unquote, late compared to what TSMC is working on. But what they did do is they did take a stratospheric leap forward from where they were before. But then there's the capacity side, which is the sheer amount of wafers that can come out of each company, is where Intel would have a very long way to go. Now, signing up somebody like an NVIDIA, like an Apple, like an AMD, or a Broadcom could narrow that gap significantly, and it wouldn't even have to be on bleeding edge, right? Any of these companies could take, let's say, their mid-range lines, where Intel is more than capable in 2026 to be able to manufacture all of these different parts.
Signing up for Intel, that's what it's going to take to get the threshold, basically, to get an exemption when Trump talks about semiconductor tariffs?
Yeah, it is. And, the carrot that I talked about says, hey, if you make a commitment to Intel, we'll give you some sort of tax abatement, or we will cover maybe part of the cost or cover the risk of having to do that. And then if those companies don't bite, it could be the stick, which says, okay, NVIDIA, if you don't want to sign up for any of this, or Apple, if you don't want to sign up with Intel, you're going to have to pay a tariff on those goods that are coming into the U.S. as a final product, as opposed to the chip, because we all know that most chips are not being brought into the United States for final assembly. Most AI servers are actually made in Mexico, and it's covered under zero tariff via the USMCA deal that was cut years ago in Trump 1.0.
Intel up last week by more than 23%. Just stellar rally for that stock. Patrick, thank you, sir. Patrick Moorhead of Moor Insights and Strategy. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahara. Hey, Yahara.
Hi, John. Hurricane Aaron has re-intensified into a Category 4 storm after moving past Puerto Rico. Aaron's top winds strengthened to 130 miles per hour. And according to the National Hurricane Center, additional intensification is forecast over the next 12 hours. The storm is expected to pass between North Carolina's Outer Banks and Bermuda later this week. Meanwhile, Advent International has offered to buy chipmaker U-Blox in a deal valued at around $1.3 billion. Shares for the Swiss firm jumped more than 25% Friday. You can see the pop there, following reports of the possible transaction. The acceptance window for this deal would run until around October 29th. And Air Canada suspended plans to resume flights after the union representing flight attendants defied a return to work order yesterday. The government ordered staff back, but the union refused, calling the order unconstitutional. Air Canada now plans to resume flights this evening. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next on the program, the path for a Fed cut.
One of the reasons I support the 50 basis point cut right now is that you have the inversion in the front end of the curve that's something like 60 basis points last time I looked. And so you know that you can cut by that amount without really upsetting things.
A conversation up next with Gennadiy Goldberg of TD from New York. This is Bloomberg. We're about a month away from the Fed's next meeting. The schedule, the calendar looks like this. So on Friday, you'll hear from Chairman Powell. Then on to early September on the 5th, you'll get payrolls. A week later, CPI. A week after that, the 17th, that Fed meeting. The countdown continues with equity futures slightly negative this morning by 0.1% on the S&P, down by 0.2 on the Nasdaq. Under surveillance this morning, the path for a Fed cut.
One of the reasons that I support the 50 basis point cut right now is that you have the inversion in the front end of the curve. That's something like 60 basis points last time I looked. And so you know that you can cut by that amount without really upsetting things. But the weakest part of the market or the economy right now is housing. And so you can't have the long end go up. And that's your constraint right now.
It's the latest this morning. Investors looking to Chair Powell in Jackson Hole later this week for clues on the Fed's next move. Gennadiy Goldberg of TD Securities saying, assuming the next round of inflation and payroll data largely behaves, we believe the path for a September rate cut by the Fed has been cleared. Gennadiy joins us now for more. Good morning, sir.
Thanks for having me.
Welcome to the programme. How high is the bar to derail that rate cut expectation for September?
I mean, all he has to do is really not say a ton. I think if he just kind of clears the way and says, look, we're definitely looking at the data, but if all goes well, the market pricing is the market pricing. I think that blessing alone would be fine. I think the big risk for market is if he sounds very non-committal. That's when the October and the December pricing, there's about 35 basis points split between those two. That's when that starts to move around if he sounds like a non-committal chairman.
What's the incentive to sound committed to anything on Friday?
It's high. I think that's I'd say the bar is pretty high at this point. The data's been all over the place. You've seen the big revision to payrolls. I think they've seen enough to start to move. I think that's the key here. We're looking for a cut in September, October, December. I think they've seen enough to start moving, but you're right. In order to commit to October, December, they need to really know that things are slowing down. I don't think that's the case. So I don't think these calls for 50 basis point rate cuts in September are justified, at least not yet. But they're going to keep the door open to everything. I think the bigger problem is if he comes in and pushes back on this market pricing and he says, why do we need to cut it all? That's really when markets will start to get upset, because right now markets are trading as though that cut is secured.
Do you think that it's awkward that they're talking about cutting rates in 25 basis point sequential moves for the rest of this year at a time when investment-grade credit spreads are the tightest since 1998?
I think that the issue is things are okay on the surface level. If you dig down into certain parts of the economy, if you look at housing, for example, if you look at certain portions of the U.S. consumer, there are some stresses. But overall, if you do kind of a top-down analysis, there's really two problems. One is that inflation is a little bit uncomfortably high, and we don't quite know the pass-through yet. We know it's kind of getting through there, but it's not as terrible as predicted. And the other one is that, yes, consumers are moderating their purchasing. So do they need a little bit of help? Does housing need a little bit of help? I think 25 basis point increments make sense. You kind of start the process. And, to John's point, you don't commit to anything. You just make sure that you kind of react to the data as it comes in.
I keep thinking about a conversation that we were having last week about, can you have your cake and eat it too? Can you essentially have a really good economy and a labor market that continues to be robust at a time where inflation continues to go down, even though right now you still have it at a relatively sticky pace? Can you, or is that a fantasy?
I think it's, that would be a fantastic end to Chair Powell's career where, we've got inflation basically back at 2%, the labor market at full employment, and you could just sail out into the sunset. That would be fantastic. Reality is often different, but yeah. Of course, reality is often a little bit different. I think if they can make sure to keep inflation under control, I think that's really what's keeping them from cutting rates here. And if you look at the labor market's starting to soften up a little bit. You are starting to see a little bit of a drift higher in the unemployment rate. We expect more of that in the second half of the year, a little bit less in consumption, a little bit less in hiring. It's not a very dynamic labor market. It's low hire, low fire, right? The problem with that is when you fly that close to the ground, it doesn't take much to upset the apple cart.
When you said data's all over the place, do you trust the data?
I trust the data in as much as I've always trusted it, right? And there's a hierarchy of data, right? First and foremost, you get the anecdotal data. You dismiss, I would say, 95% of that or more, because that doesn't tend to drive things. Then you get survey data, then hard data, and then really you get, I would say kind of stretches of data, and you look at averages. So you look at the 3-month to 6-month moving average of something like a payroll report. Those recent revisions really pushed those averages a lot lower. That's what the Fed's looking at for direction. It's not necessarily the next ISM print. It's really the trend in, the labor market, the trend in inflation. And from what they're seeing right now, I think there's enough to start the process of cuts, but not necessarily enough to commit to, 150 basis points of rate cuts, let's say.
But going forward with a highly polarizing, what some would say bias economist leading the BLS, would you continue to trust the data, or is the gold standard out the window?
I think we'll have to see if, exactly who gets confirmed, first of all. I think there's a confirmation process where I do suspect there's going to be some pushback, especially if the views are seen as overly biased. The BLS also has several thousand people employed. There are rule books and manuals. If we start to see that being broken down, then of course I think the data will be suspect. But there are private sector surveys. ADP then suddenly becomes much more important for the labor market. The issue is really not a comprehensive data set for inflation. That's the big problem, because everything feeds into the PCE report, which then the Fed uses. So it's not just, it's not that simple, I would say.
Let's talk about the top of the Federal Reserve. We spoke to a Fed chair candidate, Mark Summerlin. You heard a piece of that sound, that interview coming into this conversation. Lisa asked him a fantastic question about what he would do if long-end rates started to rise as they were cutting interest rates. And he was very blunt. He just said, you stop. You stop, because that's not what you want to see happening. That is what happened last year from September onwards. Do you see a risk of that repeating all over again?
I think if you view inflation as not being under control, then absolutely. And I think the issue right now is the Fed's got this very delicate balancing act. They want to start to ease. They want to start to help the economy because they are worried about the labor market. But if that inflationary pressure continues to build, I think the problem becomes they may actually have to stop. Or, I've heard floated, yield curve control as a possible alternative. I don't think we're there yet. I think the Treasury is already starting to worry about it by shifting some of the issuance to the front end and buying back more longer dated debt, right? So the worries are already there. It's just a function of, does the Fed keep moving if that continues to happen? We expect the curve to keep steepening, by the way.
Just quickly, what's your highest conviction trade given all of this? That seems very, very certain here.
I think it makes sense to start legging into duration. We are, whether it's September or October, we are seeing the Fed looking to restart the cutting cycle. All kind of signs point in that direction. I think the 7 to 10 year parts of the curve look especially attractive. The 5 year and under is where everyone's kind of hiding out and parked. So if you can extend out to 7s and 10s as rates start to drift lower, I think that makes a lot of sense here.
Gennadiy, appreciate your time. Thank you, sir. Gennadiy Goldberg there of TD Securities. Fantastic piece over the weekend from Peter Scheer of Academy. He put this quote in there. People seem so fixated on whether people would cut or not and not interested enough on what future potential Fed picks would do with policy to impact the longer end of the yield curve. That's a debate, a conversation we've been having too.
How do you manage the balance sheet at a time when potentially that could be used as a tool to bring rates down at the long end at the same time that they're cutting rates on the front end?
Bond yields down at the long end this morning, at least. We're down by 3 basis points at the very long end on 30s, 489 there on 10s. We're down by 2 to 429 at the very front end of the curve, down a single basis point. Your 2-year this morning at 374. Coming up on this programme, we'll catch up with Jack Manley of JPMorgan Asset Management as we count you down to a big week full of retail earnings, and then it concludes with Chairman Powell at Jackson Hole on Friday. Plus, we'll speak to Aneesha Sherman of AB Bernstein, Claudia Sahm of New Century Advisors, and Chris Heisey of Merrill and Bank of America Private Bank. From New York City, the third hour of Bloomberg Surveillance. Up next.
We're sort of in a stagflation-light environment.
I think the economy is slower than people think, and we're seeing pockets of inflation.
The big picture is it's an economy that continues to perform. It's just not as dynamic.
We're not seeing the big broad-based kind of price pressures yet.
We see the economy flattening out here in the second half of the year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bell about 90 minutes away. The third hour of Bloomberg Surveillance starts right now with equity futures on the S&P down by about 0.1%. Your week ahead is shaping up like this, a focus on retail and a focus on the Federal Reserve. Retail earnings through the week from Home Depot, Target and Walmart. The Federal Reserve in focus in Jackson Hole, Wyoming. Chairman Powell in Jackson Hole looking for some clues on what might happen about a month from now.
Does he confirm the idea of a September rate cut and then sequential rate cuts after that? Does he talk about what he's seeing in the labor market and the dual mandate of the Federal Reserve? And this comes after retail earnings that are expected to come in probably pretty strong. If you look at the previous earnings reports that we've gotten so far in Q2, which have been pretty robust, well above what people have expected, and kind of pits the sort of S&P versus the economy. And it's sort of this conundrum that the Fed has to counter, which is financial conditions seem to be pretty easy. So then how do you talk about the need to ease monetary policy?
With great difficulty. Let's get into it. The S&P 500, all-time highs. You talked about credit spreads. Not just high yield, investment grade as well. Super, super tight.
And it comes at a time when people say that companies are in a great position. They've termed out their debt, so they're not paying some of the very high rates. They look at profits that actually are growing faster than people previously expected. So square this peg, right? Square this circle. This is a really difficult moment. I always get expressions wrong. Apologize. It is a Monday. But going forward, I just wonder how the Fed justifies rate cuts without seeming like they are just dealing with political pressure from the White House.
Well, let's focus on the debate of the moment, the labour market. So the title of this year's get-together is a labour market in transition, then a bunch of other words. So let's just focus on the labour market in transition. We've had a step down in payrolls growth. What is the source of the step down in payrolls growth? Is it a turn in the economy or a structural shift on the supply side? And that is the source of great division on Wall Street right now. And I just wonder if Chairman Powell makes a call, takes a side, tells us which side of the debate he's on at the moment, or whether he's still open-minded about September and beyond.
If it is a structural issue and it's more of a supply issue than a demand issue, then ultimately, wouldn't this go against the potential rate cuts that a lot of people are predicting? Because ultimately, it would mean that this is a labor market that is just fine, and that the lower numbers are simply because there are fewer immigrants coming into the United States and because people are aging. If that's the case, it has pretty significant implications for where the neutral rate could be.
Also, there's been a lot of economists that have come on this program saying, what do you expect when it comes to the labor market report, when companies continuously told us for months that at the moment they're just on the sidelines waiting to understand clarity from Washington, D.C. when it comes to tariff policy. So they're not going out and hiring a ton, but they're also not firing. So basically, you have a frozen labor market.
A frozen labor market. Looking ahead to more labor market data. Jobless claims on Thursday morning. And then, as we've repeated throughout this morning, the main event on Friday, Chairman Powell in Jackson Hole. Equities at the moment pulling back by about 0.1% on the S&P 500. Coming up this hour, we'll catch up with Jack Manley of JPMorgan Investment Management, with stocks sitting close to record highs. Aneesha Sherman of Bernstein looking ahead to a key week of retail earnings. And Claudia Sahm of New Century Advisors on why September Fed rate cut is not guaranteed. We begin this hour with stocks little changed as traders await the Fed's annual retreat in Jackson Hole. Jack Manley of JPMorgan Investment Management writing, while the Fed will likely succumb to cutting pressure in September, investors should realise that the trajectory for interest rates may not be as aggressively dovish as recent data suggest. Jack joins us now for more. Jack, good morning.
Good morning.
Just build on that quote a little bit more for us.
Yes. So I think, Lisa, you were bringing up a very interesting point there about what's going on with the labor market and how a lot of that recent data have, I would say, maybe been misinterpreted. I mean, there's a reason why Powell talks about the unemployment rate and not necessarily about payroll gains, because when you are dealing with structural complaints or structural constraints to the supply side of labor, it would make sense that there are not as many hires out there. And Annmarie, you mentioned, right, that fires are still pretty low, right? Jobless claims are still pretty low. It is a reasonably tight labor market. So that, to your point, right, is one reason why perhaps we don't need as many cuts as perhaps the market is cheering for. I would also say you can get a sort of similar story out of last week's CPI data, right? I mean, we know that tariffs in one way or another are going to at least modestly increase goods prices. We know that companies have been able to pad their margins a little bit and so eat that a little bit through the first half. We know that businesses were able to build up inventories, but at some point that's coming here. And you also know that the underlying consumer seems to be doing pretty well. I mean, you have stock prices at all-time highs, as you said, John. You got a lot of fiscal stimulus coming down the pipeline. Again, further evidence that you don't need a ton of easing here. But I feel like we're in this weird cycle right now where we're all caught up around this idea that the Fed needs to shift to be aggressively dovish in monetary policy because we are on potentially the cusp of a recession. That, to me, is the wrong conversation to be having. Powell has very explicitly said that he considers monetary policy to be restrictive. You look at the dot plot, it tells you more or less the same thing. Why would policy be restrictive at a time when there is so much uncertainty? Why not downshift into neutral? So I can stomach the September cut or two. I can't stomach this idea that we're going to cut by 200 basis points. That, I don't think, is where we are right now.
What do you think neutral is?
Neutral is probably somewhere between 3 and 4, so let's call it 3.5%. It's difficult to see what neutral would be in a world where the labor market is structurally supply-side constrained, which maybe keeps wages a little bit firmer, which maybe keeps consumption a little bit stronger. Maybe neutral is higher than it was 5-6 years ago, but neutral is not 4.5%, which is right around where we are right now.
So if the Fed does start getting to that place, is that supportive of valuations in markets where they are currently?
No, but it helps. I mean, I think it's very hard to look at equity market valuations today and say that, a quarter point off of the Fed funds rate all of a sudden makes this okay. I don't think that's necessarily what's going on here. But at the same time, if you look at what's driving equity market valuations into the stratosphere, which frankly is where they are right now, it is still that very small handful of tech-focused names that investors are betting on over the long term. And that's important, this idea that we're looking out over the long run. I mean, you're not buying, an AI hyper giant for the dividend they're going to pay next quarter or for, the next 12 months of earnings. You're buying these companies because you think in 10 to 15 years, if you don't own them, you're going to be out of a job and in the line of the soup kitchen, right? I mean, that's why you're buying these things, to protect yourself against long-term structural changes to the economy, to generate wealth that way. And if that's how you're thinking about this stuff, you don't care about next 12-month earnings, which means you don't care about where valuations are right now. So I guess I answer that two ways, right? This idea that, on the one hand, a quarter point doesn't make much of a difference and valuations are pretty rich. On the other hand, maybe valuations don't matter as much when you're focused so much on these tech names that are inherently longer term.
So I was going to ask about whether it does help some of the rest of the 493, but the more that you talked, the more it sounded like you kind of think it's a bit of a tulip phenomenon, that you kind of are getting a little bit concerned about what you're seeing with people betting this as a card into the future, that if they lose their job and a robot takes over, they can at least get paid.
They got a slice of pie.
Exactly. I mean, is that essentially what you're saying?
I mean,
this is bubblicious?
Sort of. I mean, could it be that I'm just sick to death of hearing about AI? Maybe. maybe I'm just jealous, Maybe that's my problem. But I do think there is a little bit going on here where people are just awfully excited about this stuff and its ability to fundamentally transform every aspect of our lives as we know it. And frankly, it just hasn't yet. And I'm not a technologist. Maybe I'm something of a Luddite. But it's hard for me to imagine that over the next 12 months, there's going to be some sort of paradigm shift. You look at what's going on in the equity market right now, and I think that's reflected. What was very interesting is in the first quarter, even first half of this year, you were looking at a significant broadening out of participation when it comes to price performance. The Mag 7 accounted for 60% of the returns last year. They were accounting for 30% of the returns this year. That number has creeped up to now 50%, and we're looking to be heading higher. The market's back where it was, or heading at least in the direction of where it was last year and the year before, back on this AI hype train. And so, yes, maybe a little bit of concern.
So what could be the catalyst for the downside then? Because the market's already pricing in rate cuts, AI, and the likes.
I would say policy change has the potential to be a catalyst for a downturn, in the sense that there's still a lot going on underneath the surface that we don't have a whole lot of clarity on. This administration campaigned on this idea of making significant changes to a number of different policy buckets, and trade and tariffs have certainly been front of mind. Immigration kind of bubbles underneath the surface. There are other things out there that we don't hear as much about, I think, particularly on the regulatory side of things. And there is all this excitement about deregulation and its potential to turbocharge productivity and make a lot of these other problems go away. Let's see what happens on that front, right? Is deregulation really just aimed at crypto, or is it a broader story? So that, I think, could be one of the things that serves as a catalyst for at least short-term sell-off.
2026, what are you worried about in terms of policy uncertainty in Washington?
I think going back to the regulatory stuff, I think that's important. I think that also, we are at this interesting sort of geopolitical crossroads where the world feels kind of scary, and it's felt scary for a while, but maybe it feels a little bit scarier. Again, maybe I'm just spending more time reading about this stuff, and so I'm just a little bit more tuned in and a little bit more worried. But I think you have a market that, especially with where valuations are right now, with so much uncertainty from a policy perspective, so much uncertainty from a macro perspective, because nobody knows what the heck's going on, so much uncertainty from a rates perspective, you got a lot of opportunity for little shocks to the system. And I just think I'm constructive on stocks. I think stocks go up. I know stocks go up over the long run. I think stocks go up probably over the short run. But I think you may see a lot of chop between now and whatever that ultimate goal.
Do what Europeans do. Take August off, Jack.
I'd love it.
It's good.
I'd love it.
Jack Manley at JPMorgan Asset Management. Thank you, sir. What do they say? It's always a bubble if you don't own it. Something like that.
Yeah, well, I mean, look, I am sympathetic, though, with this view that people don't know how to value some sort of moonshot, right? And that's essentially what people are pouring into. I'm sympathetic to that view. I'm also sympathetic to the view of just being sick of reading about the same stories over and over again. So, Jack, I'm sure a lot of people are nodding along and saying, I want to take the rest of August off, too.
That sounds great to me.
European style. It's perfect. We should all sign up to it.
All right. But you actually signed up to the opposite, so you can explain why.
I'm slowly transitioning the whole of this company to the European style way of thinking in America.
Is that so?
Are you?
The biggest load of crap I've ever heard.
Where are you next week, Lisa?
Okay. I am going to be enjoying my life.
As you should.
Hiking.
A week's vacation.
Yeah,
There we
exactly.
go. Where are you
great.
tomorrow?
I'm supposed to be off.
On vacation. Let's get you an update on stories elsewhere this morning
Where
with your
are you gonna
Bloomberg
be?
brief. Right here I'm working. Here's Yahara. Hey, Yahara.
Hi, John. President Trump is hosting Ukrainian President Zelensky and European allies in Washington today. The goal is to set out terms for a potential peace deal with Russia, with the focus on territorial concessions and Kyiv seeking security guarantees. This after President Trump and Russian President Vladimir Putin met in Alaska with few details on what exactly was discussed. Meanwhile, hundreds of thousands of Israelis took to the streets to protest Prime Minister Benjamin Netanyahu's plan to expand operations in the Gaza Strip. Protesters are calling for the government to negotiate freedom for the remainder of the hostages to end the war, even if it means leaving parts of Hamas intact. Netanyahu suggesting the demonstrations would embolden Hamas. And President Trump is taking aim at mail-in ballots, posting on Truth Social just earlier. I am going to lead a movement to get rid of mail-in ballots, and also, while we're at it, highly inaccurate and very expensive and seriously controversial voting machines. Trump says he will sign an executive order that he says will help bring honesty to the midterms next year. That's your Bloomberg Brief. John?
Yahara, thank you. This is why I love financial markets. Don't have to talk about those stories.
100% agree with you.
Just thank you
exactly.
and move on.
Yeah, no, that's exactly how I feel about it. That's the reason why I love financial markets. It's sort of the collective view of what matters. And right now, that's not it.
What do you always say? How about those bonds?
Yeah.
How about those bonds?
Amen to that.
Up next, the Morning Calls Plus, Aneesha Sherman of Bernstein, as the major retailers get set to report earnings through the week. From New York, this is Bloomberg.
There's clearly some weakening in the jobs market. What's important about it is that it really undercuts this argument that a lot of hawks are making that the slowing in the jobs market is largely a supply-driven phenomenon. I mean, did we have a bunch of college graduates swarming across the border over the last 3 years? So I do think that demand is the principal reason why labor market conditions have slowed.
Neil Dutta of Renmark looking for a rate cut in September and looking for Chairman Powell maybe to lean into that idea just a little bit. Equity futures this morning negative by 0.1% as we count you down to the opening bell. That's your price action. Here are your morning calls. First up, Stifel raising its price target on Home Depot to 432, saying expectations for lower rates are driving out performance. Your second call from UBS slashing its price target on Lulu to 240, pointing to, quote, lackluster sales momentum and tariff-related headwinds. And finally, Evercore adding target to its tactical outperform list, forecasting increased earnings and near-term upside. Let's stick with retail. Investors looking ahead to a slew of retail earnings out this week, with consumer sentiment sliding for the first time since April. Joining us now to discuss is Bloomberg's Anna Wong. Anna, welcome to the programme. It's good to see you. It's been too long. I wanted to throw this at you. It comes from Mike Dada of Roth, who said, quote, overly restrictive monetary policy would by definition lead to inadequate nominal spending and income growth. He went on to say, we would likely also see credit spreads widen and inflation expectations fall, neither of which is happening. That's a case not to cut. Anna, would you take the other side?
Well, I think the issue right now is that the tariffs, whether they are biting, we haven't seen a tremendous evidence that it's biting, partly because firms still have been stockpiling things, and consumers are just starting to feel the bite of the tariffs. And I think the retail earnings later this week will show that we are starting to see just a little bit of a consumers hit from tariffs.
And just on the pre-tariff inventory, they clearly front-loaded a lot of product. How much of that are we still working through?
Well, it depends on the sector. So I think for toys and for Home Depot and the likes of Target, they haven't really front-loaded too much. It's just that they have been trying to raise prices, and yet consumers are pushing back slightly on it. But on the other things, such as sports equipment and audio equipment and photography equipment, those seems to be able to pass through tariffs quite briskly, and consumers are not really pushing back on those, because consumers who are buying those stuff tend to be the ones who are higher income and are experiencing some income positive impact from the stock market rally in the last couple of months.
And just finally, are you expecting a sequence of cuts from September? Is it the start of something bigger?
We are not so sure that there's a cut in September yet, given that, as I mentioned, the evidence of a tariff biting on the economy is not yet really showing, and the demand side slowed down in the labor market is just slightly faster than supply side, not tremendously faster. So I think our call is still for a December rate cut.
Anna Wong of Bloomberg Economics. Anna, thank you. Looking for December and not September. Joining us now to discuss, Aneesha Sherman of Bernstein. Aneesha, welcome to the programme. We had that conversation just briefly there about product. How much pre-tariff product do you think is on the shelves of these companies that report this week?
There's not much left. So there was a lot of stockpiling in January to March this year. Then there was a freeze when the April tariffs came out. And then there was a little bit more that came in May and June during the pause rates. But the flip side to stockpiling product is having an inventory glut and then having to clear it at massive discounts. And this is exactly what the retail sector went through 2 years ago in 2022, when a lot of product was brought in, stockpiled, and then 2022 and 23 saw aggressive clearance and a lot of hurting margins. And retailers are wary of that because they're primarily worried about demand. And as your economist just said, we haven't seen the demand impact yet of price increases. We're going to see that now in the next coming weeks. We've already seen consumer sentiment dipping and inflation expectations going up from the Michigan survey work. So it seems to suggest there should be a pullback in demand. We haven't seen it yet. So retailers are very nervous, and they're actually underbuying. And I think there's more of a risk of stock outs in the holiday period than there is of an inventory oversupply and pull forward.
Which raises the question, Aneesha, about pricing power and whether we are going to see prices go up, and whether it could really start with Walmart on Thursday, since they are the biggest non-public employer in America. Could you start to see an indication that they're going to have to raise prices?
They are doing it already. I mean, we are already seeing big retailers. Walmart's already said they're taking pricing up. Many of the companies in my coverage around sporting goods, sports apparel, footwear, discretionary retail, they've already started taking pricing up. It hasn't been peanut buttering a price increase on every item. It's been very strategic and careful and trying not to throw off consumers, but they have been doing it. And so the question is, has that driven some price elasticity yet? It perhaps might be too early to tell. But also, I think where the indication of that will be in how they guide for the next quarter. Q3 started in August, and so we're already a few weeks into it. How they guide for Q3 based on their expectations of demand and price elasticity will be really indicative of what the trends are they're seeing at the moment and how much we should worry about this.
How much, Aneesha, from the companies that you covered, do you get the sense that people are trading down, that wealthier consumers are trying to cut costs on the edge, or is it the opposite? Are some of the discounters trying to cater to wealthier consumers since they continue to spend? They're the ones supporting the American consumption economy, whereas the lower income consumers have really fallen behind in a material way.
We are seeing trade down behavior. So retailers that offer a good value proposition, mass retailers, off-price retailers are seeing those traffic gains. And the ones that are losing are the ones in the middle. So if you are premium or high end, you're probably a little bit more resilient. We saw Tapestry reporting last week. They said Coach growth in North America is 16%. So there are companies at the higher end that are still doing fine. It's the middle that's getting pulled in a little bit, and this trade down is happening to value. And so some of those value retailers that report this week should see some positive comps. So we are seeing some trade down behavior. It's not a massive move yet because, as I said, those price increases haven't quite rolled out fully yet, but they've definitely started. And so I think that's the real-time data we're looking at now.
Aneesha, you said those price increases, they've been strategic when it comes to consumers. Have they been strategic when it comes to the White House? On Friday, there was this Axios report that the White House is keeping track of all of these companies and how much they're a part of the Trump agenda. When these retailers report and then get on the earnings call, how careful do they need to be with their words, thinking of an audience of one?
That's an excellent point, and they have been. And if you look at how they've been talking about it, they've been very careful to talk about price increases, and they've talked about it in a way that is, they're doing it very carefully. They're being strategic. They're continuing to offer value. They are not talking about it very bullishly in the sense of kind of slapping a price increase on everything, because that is one of the concerns they're concerned about. It's not just the demand side; it's also the implications of talking too aggressively about a price increase.
Aneesha, just finally, what's your top pick right now? What are you advocating for to clients?
I really like TJX. I think, we could see a dip if the earnings are in line because, if we're expecting a rate cut, a safer name like TJX could get sold off. If it does, I would be buying into that dip. This is a rock solid name into the second half. If there's any moderation in consumer demand, any pullback, any trade down, this one should be resilient and should be a beneficiary and a share gainer.
Aneesha, you're one of the best. Appreciate your time. Thank you. Aneesha Sherman there of Bernstein on the retailers right now. We've seen the decline, the deceleration in fast casual restaurants. I'm thinking of Carver, I'm thinking of Chipotle. I just wonder how much of that is going to show up in these numbers later this week.
Yeah, especially because right now it really is a tale of two different companies when you have the winners and the losers. For example, you have Chipotle coming out and saying that their fried chicken burrito didn't really work. And then you have McDonald's coming out and saying that their Happy Meals were great. So put them together and ultimately it's very difficult to get.
Have you tried that, the fried chicken burrito? Is that a thing?
I haven't, but I was looking at some of the granular explanations for why Chipotle underperformed, and that didn't overcome the PR miss for not putting enough chicken in the burrito bowl. That was what I found.
I missed this. Was that actually a thing that took place? People complained about that.
Oh, they measured it. It became a social media fad.
How did I miss this?
I have no idea. That seems like something you
very
totally
online. I would pick up on these
Exactly. You
things.
absolutely would say, are we getting cheated out of our chicken?
Because you don't eat Chipotle.
Exactly. So
No, sure, but I'm on Twitter. I'm on X.
But this was a very, very vehement argument. It was something people felt very strongly about. And then on the flip side, people love Happy Meals and Happy Meals.
5 hours of doom scrolling every single day, and I managed to miss that story. All right, up next, Claudia Sahm of New Century Advisors on why September rate cut is likely, but not in the bag. Plus, Danny Berger with your morning movers as the rally continues for United Health. Their stock is up again by 2.7% so far this morning. From New York City, you're watching Bloomberg TV. Coming into Monday, close to all-time highs on the S&P 500, and credit spreads haven't been tighter on this side of the century. Equity futures negative by 0.1% on the Nasdaq 100, down by 0.14. In the bond market, looking ahead to Chairman Powell, bond yields just about unchanged on a 2-year 3.74, on 10s, giving up some of the rally on a 10-year 4.31, and the long end of the curve. Bramo coming into sharper focus, I would say, going into that meeting next month.
Yeah, a real question about how much they can cut while keeping some sort of cap on how high long yields can go. Because ultimately, everyone keeps saying mortgage rates are too high, lower rates. And it's sort of a head scratcher when you think that they lowered rates by 100 basis points last year, and long-term rates, the mortgage rates, they rose.
I'm not going to say this is a conversation at the FMC right now, at least not in public, but this is a conversation in markets big time. Pretty much everyone in fixed income is talking about this. Could we see a repeat of last year? And I go one step further. The market conversation, as you know, is about what the Fed might be able to do about it with a new Fed chair a year from now.
If you have somebody who truly is an activist Fed chair, could they deploy the balance sheet in a way of Operation Twist or even more aggressively yield curve control, which would be a pretty jarring departure at a time where there hasn't necessarily been a financial crisis.
The difference between 2s and 30s this morning, about 117. With 1 hour away from the cash open, 60 minutes away from the opening bell with your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. United Healthcare for a second consecutive trading day. It looks like it will be outperforming. It's up nearly 3% in the pre-market. On Friday, it rallied 12% after Berkshire Hathaway and other hedge funds added to their share in the latest hedge fund filing. Of course, United Healthcare has been beaten up this year, issues with poor earnings and otherwise really weighing down on the stock. We're also looking at Target outperforming this morning, rallying into its earnings on Wednesday. It was up more than 1%, that ebbing a little bit, just up about 0.9%. Evercore adding it to its tactical outperform list, saying that the expectations are reasonable for Target and it sees no reason to downgrade them in their earnings. Again, those come August 20th. Finally, Novo Nordisk, those ADRs rallying in the pre-market session, up 3%. Eli Lilly, those sink by about 1/3%. Their Wegovy got approval to treat a rare liver disease in the U.S., beating out its competitor Lilly to do so. John?
Thank you. Appreciate it, Danny. Thank you very much. Danny Berger there with your morning movers. A busy week of data and Fed speak ahead with a highly anticipated speech from Fed Chair Jay Powell just days away. Looking ahead to it is Mike McKee. Mike, welcome back to the program. Good to see you in Jackson Hole, Wyoming. What can we look forward to later this week?
Well, that's what you're looking forward to, John, later this week, because there isn't much going on other than we have a bunch of housing numbers coming out this week. Home builder confidence today, and we get existing home sales and housing starts. And everybody knows that the housing industry is in trouble right now. But Wednesday, we get Fed minutes. People will be looking back to see what the Fed was thinking about a September meeting. And then Friday, maybe Jay Powell tells us, I know you guys have been talking about this all morning, will he give us some sort of hint, as he did last year when he said it was time for the Fed to start cutting rates? Or will he say we need to see more data? Or will he touch the subject at all, because it's long been thought that he's going to tell us something about the Fed's new framework review and how the Fed will look at doing their monetary policy decisions in the future?
Mike, a lot of people have priced in a lot from this Federal Reserve starting in September, beyond this year, going into 2026. I've seen a lot of pushback over the past week, Mike, from Mike Dada, from John Riding, from Mike Gapin over at Morgan Stanley. Mike Gapin said if Chair Powell wants to retain optionality, he will likely push back against market pricing at Jackson Hole. Is that a consideration, Mike, from the people you've spoken to going into Friday?
It is a consideration, and there are some economists out here that we have talked to the last couple of days, and the feeling is that Powell does need optionality because of what's happened with the inflation numbers over the past week or so. And they don't want to go into the meeting with the markets having so firmly priced a cut that there would be a big market disruption if they didn't deliver. So my bet at this point would be that he tries to walk a very fine line without confirming anything about September, unless they are really ready to go. And with the data the way it is, it's hard to say that's the case.
Mike McKee, looking forward to your coverage, sir. As always, Michael, thank you. Things can change again in early September when we get that payrolls reprint, and a week later when we hear the latest on CPI.
That's why Andrew Hollenhorst over at Citi just put out a note saying that it is unlikely that he is going to commit to a cut next month because he is awaiting that jobs and inflation data coming out in the next few weeks. He might signal a willingness, but commit? What's the upside?
Let's stay on this topic. Claudia Sahm of New Century Advisors writing, now is the right time for the framework review. The changes to the framework this week will largely reverse key changes made 5 years ago. Claudia joins us now for more. Claudia, welcome to the programme. Let's just start with that speech on Friday and the decision a month away. Just how finely balanced are things at the moment?
The Fed is facing a really difficult decision. It's clear from the recent data, particularly employment data, that we have a dual mandate that is in conflict. And that is the hardest situation for the Fed to navigate. It's something that they talk about in their framework. I'm sure he'll talk about that on Friday. But it's, this is tricky. And there's no, that's why they need the data. They need each individually as members to think about their outlooks, their forecasts, where does this land? So that's why I think it's appropriate for Powell to outline how tricky the decision is, as opposed to trying to, it's September, it's October, not get into timing, just lay out what it is that they're trying to deliberate on.
So, Claudia, let's get into that. The idea of the framework. There's on one hand the 2% inflation target, which they already have talked about average targeting, and they're going to have to illuminate on that and discuss whether they want to actually increase that target slightly. And then there's a question of how they treat policy when there is a conflict between the dual mandate. So what are you expecting them to come out with, and how much could that actually shift market expectations of how much they'll cut?
Right. So there's going to be a lot changing in the framework. I think if you're wanting to understand current policy, maybe you can set some of that to the side because it reflects assumptions that the pandemic overturned and they're kind of catching up in their strategies and tools. The pieces of the framework that aren't changing on Friday are some of the ones most important right now. So the 2% target, Powell has said repeatedly it was off the table for this framework review. They will affirm the 2% target. And let's all remember, we've been above 2% for more than 4 years, right? So that setting is important. And then the piece that will get a little tweak, but probably remain intact, is how they deal with when the mandate's in tension. They think about how far do we expect this to get off track? And how long is it going to take us to get back to the goal for each the employment and the inflation mandate? And I think, again, if you look at the data we have in hand and we think hard about where inflation is and where it's been the last 4 years, inflation still comes up on top as the primary concern of the Fed and thus calls for the restrictive rate cuts. But it's a very dynamic situation. New data comes in on the labor market. The risks are, things could move pretty fast. But those two pieces of the framework, I think, are really, really important for thinking about how does the Fed go forward as they're learning more about the economy.
For people who are listening to this and think that it's an academic exercise and coming up with different puzzles to put things together, it's actually incredibly important to understand whether this is just an inherently dovish Fed, whether this is a Fed that wants to prolong the economic cycle for as long as possible because it takes so long to get jobs back when there is some sort of huge wave of layoffs. Do you expect them to sort of codify that type of approach, which has been the assumption right now in markets for a long time, that they are more willing to allow inflation to be higher for longer in order to avoid that type of punitive and long-lasting reaction in labor markets?
So I'm somewhat concerned that the new framework is going to be read as hawkish, not, going to bat for the labor market in the same sense. I don't think that's the right interpretation. I think when the changes were made to the framework 5 years ago, we were in, the years after the global financial crisis, low inflation, low interest rates, unemployment rate was low. The Fed was trying to find tools to give some more oomph to the economy to keep us away from the zero lower bound. And so there were changes made tolerating unemployment that gets unusually low because, that could be good for the labor market going forward. And it didn't cause inflation in the past, and allowing for a period of time modestly above 2% inflation. Again, that was all about giving the economy some extra oomph. The last 5 years, the problem has not been the extra oomph in the economy. We had inflation risks that really came back. We had labor shortages for a period of time. So there's going to be changes that reflect some of the challenges the Fed has seen in the last 5 years. But I would not see that as a fundamental, we need to, put less emphasis on the labor market. It's realizing that we have some new challenges. I think we'll see some more about the supply side of the labor market, structural changes that we're seeing that could get mentioned as well. So it's a tricky document to read, but I don't think one should come at this and say, the Fed is, going to leave the labor market behind. I think it's just really balancing the challenges they face with inflation with the challenges they face with the labor market.
Claudia, before spending a little bit more time on the labour market, can I just ask a perhaps obvious question for people sitting at home? What's the value of a framework review conducted by a lame duck Fed chair?
Right. So this is absolutely the right time for the framework review. The Fed started this in 2012. They started with a framework. It's about transparency. It's a communication tool. It is to clearly explain. It's a short document. It's pretty dense, but it's a short document to explain their principles, their strategies, big picture, high level. What are they doing? They started doing the 5-year reviews in 2020. Again, this is about transparency and accountability and having processes that they can be judged against. And it is true. This is, in all likelihood, Powell's last speech at Jackson Hole as Fed chair. And yet the framework is not the Fed chair's framework. It's the committee's framework. It is an agreement that they make together, and it isn't about one person. And also, this has been his tenure the last 5 years. So an exercise in accountability and them saying, some of the assumptions we made in 2020, those didn't turn out to be the right assumptions. We've got to make some adjustments. So it's a great time. And above all, they told us 5 years ago they were going to do this review. There's a lot that's changed. It's not a comfortable environment for the Fed to be out in public.
True.
But they're doing the review. And that is so reassuring that we have a process that's working as planned.
We'd love to hear your assumptions on a few things, and particularly the labour market. So let's start with that. The source of great division on Wall Street at the moment, and that's whether the step down in payrolls growth is a factor because of what we've seen in the economy, a cyclical turn, or maybe a structural shift with what we've seen on the supply side of the labour market. Claudia, do you have a bias as to which one it is right now?
It's almost certainly both. I think there's a lot of supply side in there right now. And we can see this at utilization numbers, like the unemployment rate has been basically flat, right? So we're not seeing the unemployment rate climb as of yet. And also wage growth has not really, weakened. And those would be signs that it's demand. Now, there are absolutely risks in the labor market, and they're not hypothetical anymore. We can point to data that slowing jobs growth could be a real issue. And yet there are policies, supply policies, that are at play too. And when we think about the Fed and the way the Fed thinks about the labor market, it's important to remember the Fed does not fight the trend. It can't fight the labor supply. It's trying to smooth out the sharp movements in demand that, can cause, a weakening in the labor market. So it's a tricky situation, but I think there really are signs that a good bit of this is supply, and it is almost exactly the reverse of what we were trying to sift through last year when we had the surge in immigration.
Claudia, this makes it really, really difficult to communicate anything at the Federal Reserve. And given the title of this year's get-together is a labour market in transition, do you believe that the chairman has to make a call here going into September as to the dominant factor he thinks is driving markets, the labour market specifically, at the moment?
I doubt that he'll give us the full picture. I mean, it's one that's still developing. Again, I think by widening and not just saying, oh, well, yes, labor market's weakening, that job growth is too low. Like, he's not going to make a definitive statement that things are really, the risks are really rising rapidly. I think it'll lay out all the different pieces that they're grappling with. And what better thing for them to spend a weekend grappling with the research and talking to scholars and people in the area than structural changes in the labor market? Right? Like, they need to be as on the cutting edge as they can be as they sift through the data and they decide the policy. But they're not there yet. And he's not going to front run the committee and make the decision for September. What possible good would that do? He can be transparent about the process, be honest about what they see in the data. And, we'll see where this goes in terms of a decision. I do expect him to affirm that the next move will probably be a cut. Right? We're talking about timing here.
Yep.
We're not, talking about, do they raise rates next? So I think, we just keep it all in context. We're not going to get the answer that maybe investors are looking for, but that's because the Fed is still deliberating.
Claudia Sahm with the latest on the labour market and the Federal Reserve. Claudia, thank you. Claudia Sahm of New Century Advisors. He's not going to get over his skis here. We've got 2 more big data points to come in the next month. He is facing down a very divided Federal Reserve. How committed can he be to a September call? And we've heard a lot of people on the programme already this morning saying probably a very non-committal Fed chair on Friday.
Yeah, this was what I was trying to get at, not just that I was going to go hiking, but that ultimately, if you're looking for a clean answer in Jackson Hole, you're probably not going to get it. You are going to get a framework, and then people will tell you whether it's dovish or hawkish, and you're going to hear them then discuss that for the next 2 weeks because there isn't a lot of other news for them to discuss. But ultimately, that is going to be the tenor of discussion coming out of Jackson Hole.
What's the source of the step down in payrolls growth in the labour market?
That's
I think
key.
That's ultimately the key question for me into Friday. We haven't heard really from the chairman since we had that payrolls report, and that's going to be what sets up this market going forward, I think.
Is this just an issue of people not coming into the country as quickly or even departing, and not necessarily a sign of real weakness under the hood? And that really is the key question for policy going forward.
Remember that line, an ounce of protection is worth a pound of cure? Cut now so you don't have to cut even more. later on. I wonder if that argument wins out in September too.
At the same time, what we just heard from Claudia Sahm, really key. That worked at a time when we were combating low inflation, or we were combating the zero bound. Does that work at a time where inflation is very much of a preeminent concern?
The Fed's bias is still to ease. How constrained is that easing bias? We'll have that debate through the week as we anticipate that speech from Chairman Powell going into Friday. Let's get you an update on stories worldwide with your Bloomberg brief. Let's cross over to Yahira. Hey, Yahira.
Hi, John. More troops are heading to Washington. GOP governors from South Carolina, West Virginia, and Ohio are deploying additional National Guard personnel to D.C. at the Trump administration's request. West Virginia said it would send up to 400, South Carolina 200, and Ohio 150, adding to the 800 already mobilized in the nation's capital to combat crime, according to President Trump. Meanwhile, White House trade advisor Peter Navarro is out with some strong criticism of India's purchases of Russian oil. In an FT piece, he writes American consumers buy Indian goods and India uses those dollars to buy discounted Russian crude. He went on to say India needs to start acting like a strategic partner of the U.S. if it wants to be treated as one. And gotta mention this one again because it was incredible. Scottie Scheffler pulled off an incredible shot to win the 2025 BMW Championship yesterday. The world's number one landed a wild chip in on the 17th hole at Caves Valley in Maryland. The two-shot win over Bobby McIntyre was Scheffler's 5th of the season and his 12th in the last 2 years on the PGA Tour. Incredible. That's your Bloomberg brief. John?
Ton of money as well. Yahira, thank you. I think there's a $40 million purse at the Tour Championship next week. So congrats, Scotty, on another big win. Up next on the programme, we'll set you up for the day ahead. We'll catch up with Mike McKee to look ahead to that big Federal Reserve speech coming up on Friday.
I think the Fed should cut, but I think they're going to cut for the wrong reason. You don't want to have a scenario where tech and tech capex slows down and you can't hand the baton off to that other part of the economy that's struggling. If you keep rates this restrictive for longer and you punish those parts of the economy so severely, you won't be able to hand off that baton. You're going to have to cut. You're moving in that direction.
That was Steve Chiavarone of Federated Hermes looking ahead to rate cuts from the Federal Reserve. But he thinks this economy is about to re-accelerate and he's still bullish this market. A market that comes into a brand new trading week close to all-time highs, down just 0.1% on the S&P 500, down by a similar amount on the Nasdaq 100. That's the price action as we count you down to the opening bell, about 40 minutes away. Here's the trading diary for the week ahead. Later on today, President Trump hosting Ukrainian President Volodymyr Zelensky and other European leaders at the White House. Tomorrow, Home Depot earnings. Wednesday, Fed Minutes Plus, results from Lowe's and Target. On Thursday, another round of jobless claims and earnings from Walmart. And on Friday, it's the main event on Friday, remarks from Fed Chair Jay Powell in Jackson Hole. Down in Jackson Hole, Bloomberg's Mike McKee is back with us for more. Mike, looking forward to a conversation you're set to have through the week with Governor Mickey Bowman. One of the dissents, Mike. How aggressive is that dissent going to be in a month to come if they don't cut interest rates?
Well, that's an interesting question because she gave a speech at the end of last week suggesting that she still believes they should cut in September and that they should cut 3 times this year. So she's still in that camp of the job numbers are bad, and that suggested that the economy is slowing down and the Fed should get ahead of it. Chris Waller has reaffirmed he's still in kind of the same position. So we'll have those two. The open question is, would there be a possibility that Stephen Myron would be confirmed by then and add a third dissent? I'm not sure Jay Powell would care since he's going to be leaving. And at this point, the rest of the Fed doesn't seem ready to cut rates, but they're moving in that direction if the data continue to show weakness.
Mike, I just got this message as you and I are talking. It comes from a Bloomberg subscriber. They say this: cutting more now so they don't have to do more in the future would be irresponsible for the Fed. It would create an even bigger bubble, assuming there is one right now, which would create another crisis when it inevitably bursts. That's just a view from Wall Street at the moment, Mike. But Lisa asked a similar question. Equities at all-time highs, credit spreads very tight. From the market's perspective, is this a market screaming for rate cuts?
The market is screaming for rate cuts because the wish is always father to the man. But remember what happened in 2000 when the Fed started cutting rates. We ended up having a bubble burst, and we had a problem with the economy. It wasn't as bad as some others, but the Fed is aware of that, and they're going to be very cautious about what they do. They also recognize that a lot of this is psychological. They cut rates, the markets go up, everybody's happy, but the rate cut doesn't hit the economy until sometime next year. So it's all a question of managing expectations, which will make Jay Powell's speech even more interesting.
Mike McKee, looking forward to catching up with you through the week, and Lisa will be on her way with TCAN the next couple of days, so looking forward to that too. Michael, thank you, sir. Financial conditions versus economic conditions. I think it was Neil Dutta of Renmac talking about that a little bit earlier on this morning. There's a key distinction to make.
Yeah, although at the same time, what happens is if you try to ease financial monetary conditions, then financial conditions will just get that much easier. So even though economic conditions might be relatively tight when it comes to lower income consumers and credit card debt, which is usually pegged to the front end, it's not clear that really it's going to help things as much as it might hurt if you do cut rates and foster asset prices just to go that much higher.
We've both been to a few of these. This one feels different. The president really does loom large going into this meeting. Now, of course, Chairman Powell is very unlikely to address that head on, but it's something that looms large for a lot of us all to think about at that particular get-together.
I'll give you this anecdote. Earlier this year, at the IMF spring meetings, there was a talk behind closed doors where Jay Powell spoke to other central bankers from around the world and reiterated the importance of the independence of the central bank. And there was a standing ovation for a prolonged period of time, according to a number of sources who were in the room. And it just underscores how they're not going to come out and talk about it publicly, but it is very much there present in their minds.
But also, this is, in a sense, a legacy speech for Jay Powell. This is his final Jackson Hole before he has to give up his chairmanship. And Mike McKee just said it there. Why does he care? He's on his way out. Well, is he? He has yet to tell the president or the Treasury Secretary that he is going to give up his governor's seat when his chairmanship ends.
Conducting a framework review as a lame duck Fed chair. That's quite a challenging moment.
Yeah, although, as we heard from Claudia Sahm, it also might be a chance for him to say, look, this is what we got wrong and this is what we got right. This is how I understand the record. I'm going to define my record before somebody else does it for me.
I think they're already trying to do it for him.
I am positive they are, so might as well get his view and throw it in the ring.
He's going to try at least this coming Friday. That's the main event for financial markets worldwide. Equities doing okay to kick off a trading week. A quiet start, as I've said, to a very, very busy trading week. Futures down by about 1/10% on the S&P. Coming up tomorrow, the coverage continues. We'll catch up with Brian Levitt of Invesco. We'll speak to Sarah Hunt of Alpine Saxon Woods, Priya Misra of JPMorgan Asset Management, and Jim Karen of Morgan Stanley. Equities close to all-time highs. Credit spreads are tight. And we're having a conversation about the Federal Reserve delivering rate cuts next month. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.